Mr. Rahul, can you please come on video? Good morning, everyone. It's my pleasure today to introduce Mr. Rahul Saria to all of you. Mr. Rahul Saria is a co-founder at Nimble Growth. He has served as CFO, that is head of finance, for various global and Indian startups like Vedanto, Rentomozo, and Near.com in the past. He has 14 plus years experience in fundraising, finance controllership, FP&A, business, finance, and treasury. He has been awarded CA Professional Achiever Services Sector 2016 by ICAI and also been awarded Rajya Puraskar by Governor of West Bengal. Mr. Rahul, please correct me if I'm wrong, for excellence in scouting and service to mankind. He is also an author of a book on startup finance named FinCurious. I also acknowledge Mr. Nataraj for referring the speaker and suggesting this interesting topic for us. And Mr. Rahul, I also request, if you could tell us as to what that book, contains and where it is available, our participants could be interested to read this. Over to you, Mr. Rahul.
Sure. Thank you. Thanks, Silva. Thank you for having me here. Thanks to Mr. Nataraj for referring me and getting me connected to this valuable association, I would say. Yeah, you are right. When you read my profile, that is true. So Silva, should we wait for more participants to join? Because I see that people are still joining in. Or can we start?
If you could tell a little bit about your book.
Okay, sure. Anyways,
about your experience, even Mr. Nataraj, you can feel free to share, 2-3 minutes we can, exchange this conversation. Why did you choose this topic also?
I'll just take a minute actually. So actually, where I met Rahul is very recently. I had attended a seminar in a CA institute where Rahul was speaking about startup and various other things, and I really got inspired and very nice insights he has given. I have heard about startup in various forums. I also deliver a lot of sessions on startup. However, I learned a lot in that session, and also by seeing his profile and everything, I felt he is the best choice for our association to get an opportunity to hear to him. So that is the reason. In fact, I am also curious to read FinCurious. I have not read, so I will surely, I want to read because I'm sure it will be really gaining knowledge for me. And I also suggest others to please read it. And we look forward for his enlightening session.
Thanks a lot, Mr. Nataraj, for those kind words. Really thankful to you for that. Yeah, so on the book, right? So I think, to be very frank, I'm not an professional author. It was just an accident, more of an accidental author. I take a lot of sessions across. So once I remember, I visited one of the institute called RV College of Engineering, Bangalore, for a session. The kids are so smart. I was like overwhelmed with the kind of response that they gave in terms of thinking on new ideas, using technology in the business, etc. Which is where, but when it came to finance or the subject area in where we belong to, they had no clue about it. And there are a lot of, I would say, wrong advices being given to people, to youngsters, right, specifically. So that I'll just start scribbling some notes. Maybe in my mind, I'll write some 8 to 10 page notes. And next time when I go for a session, especially for the students or for early stage members, I would just take some printouts and pass it on to them for their knowledge. That was the idea. But when I started writing, I realized that, okay, in 8 to 10 pages, it's very difficult to contain what I wanted to convey, which is where ended up doing some 50, 60 pages. It just happened. I kept on writing. And to be very frank, people say that for writing a book, it takes years. I wrote the whole thing in less than 30 days because that was just out of experience. It was just coming out. But then a couple of friends suggested, Why don't you convert this into a book? Now they cannot be a 50 to 60 pages book, right? So then I started expanding it. Then that expansion from 60 to 100 odd pages, 120, 130 pages took almost a year, because then it became a professional job to write a book, right? Which has to be very clear. It has to be every comma and full stop has to be corrected. The proofreading has to be done. Then obviously to expand it, I started putting more practical examples. Now setting up those examples, that took a lot of time, because again, that's not my professional work that I do. This is how it happened, and just then finally I launched. I think it's been around 2.5 years of total. Again, I don't do much of marketing as such for the book per se. Total book that would have been sold till date would be 2,500 copies, of which interesting part is that almost 80% has been bought by professionals like chartered accountants, cost accountants, company secretaries, etc. So that is something that I had not thought of. I had written it for early stage entrepreneurs, and of course for students or someone who wants to get into the startup mode, who wants to start their own business. But it was more liked by professionals other than the other guys. So that is something that it was interesting. It was nice to know that, okay, even professionals are getting a lot of help out of that of the book.
Available on Amazon bookstore?
Yeah, it's available on all the platforms: Amazon, Flipkart, ebooks, etc. So all the platforms.
Please go ahead, Mr. Rahul.
Okay, shall we start?
Yes, we can start.
Sure. I'll just quickly share my screen.
Are you from Bangalore?
I don't know what does that mean. I am in Bangalore since last decade or so, so I would say yes. Otherwise, I've worked across the country in different roles, like as a finance head and CFO for a couple of popular startups, as you mentioned, like Vedantu and Rento Mojo. Apart from that, I have had my own practice long back in the past, which was in Calcutta and my hometown Siliguri. So in West Bengal, basically, I'd done that, and I have even did some consulting work for a lot of startups for a few years in Bangalore and Bombay. So it has been a sporadic. I would say it's been a roller coaster ride, and stayed across the country. Right now in Bangalore since last more than a decade. So yeah,
You're
I am
you're a consultancy role, right? Not employment role now.
no. So now I run my own agri-tech company. It's a startup. We are into farming, where we work on a contractual farming model with multiple farmers across Karnataka and Tamil Nadu, where we give them contractual farming, give them technical consultancy, absolutely free of cost, pick up their produce, then do a lot of processing into those producers, and then sell it to our customers across Bangalore and Hyderabad.
So we have another topic to be approached.
Yeah, I think again, I not a farmer by background, but now I would say that I'm a farmer too. So definitely can talk a lot on agriculture, because that's like something that we do day in day out now.
Good. Go ahead.
Cool. So I'll start with this. Let people join in. So hi everyone. Sorry to start it in a very informal note, but yeah, I guess the idea is to share knowledge and learn from all of you. Wherever you guys feel you need to stop me, because I generally like doing physical sessions where it's more interactive and you get to see faces of each other. You enjoy it more. But having said that, now we are all used to with these online meetings. Wherever you guys feel you need to stop me, I'm going too fast or I'm going too slow, or there's a topic which is not of your interest, you don't want me to continue, just tell me freely. So there's no proper structure. Of course, I made some PPT, but may not be very valuable for all of you. And again, but my one request is that let's start with a very clean slate. I understand that most of you are valuers, being a valuer association, and I'm sure a lot of you must be only into valuation, or a lot of you must be into multiple other services that you give to your clients. Just a quick understanding, Silpa. Most of the members here are into practice and into valuation.
Yes.
Okay, cool. And plus, I'm sure there may be a lot of professionals who are giving other services to your clients, to their clients. So from that perspective, you may understand, you may feel that, okay, what I'm saying, it's very basic. That's okay, because there may be others who may not have even heard about it or they may not know about it, right? But we need to cover as much as possible. So idea was to share as much as possible on startups, on fundraising, and basically my experience. Mr. Nataj also gave me a good list of topics that he thinks it's appropriate, and I think I totally resonate with him, and which is what I would try to cover as much as possible. So let's start with this. A very good morning to all of you. The first thing, right, when we talk about startups is, and I want to make it interactive. If you guys can switch on your videos, feel free. If you want to speak in between, please unmute and speak. Let's make it interactive so that we make it interesting for all of us, right? Uh, the first and foremost, what is a startup? That is something that I always start my sessions with. We need to discuss and understand what is a startup all about, right? Today, if I say open a small pan shop or a masala shop, right? Is it a startup? That is a big question. So anyone would want to answer that?
As per the definition of DIPP, startup or generally startup?
It's your forum, man.
As per the definition of DIPP, it's different. They want some innovation, some new technology being, innovated. Then they are giving, of course, they're not strictly following that, but then that was the intention of, startup in the context of DIPP.
Correct.
There are
So
that's fried criteria or something less than 100 crores during any financial year, and then it is a new idea, innovation, and creating wealth and the job, and like that, five criteria are there. No, so that will be the definition of DPIIT.
very interesting. So this is the biggest challenge that we face, right? Generally, when you talk to professionals, they'll talk in all legal languages, right? That's what even Silpa ma'am asked for. Are you asking as per so and so law, or are you asking generally? So that is the biggest, I would say, challenge slash. I would say where there's a gap between the professional community and the businessmen, right? The businessmen or founders, they don't understand these languages, right? They don't need to, right? We are there for that. But when they are, suppose I ask you, right, as a founder, what is a startup? I don't give a damn what is EIP, what is this criteria, that criteria. Ultimately, is it a business or not? Right? Is it a business which I can do and I create some value out of it? Then it's a startup. Now, India has been a country where entrepreneurs are there across in the nooks and corners of the country, right? Even today, if I start a business, I would definitely want to call it a startup, though the government or some particular law may not allow me to call it a startup based on certain definition criteria, etc. etc. That's okay. But ultimately, every business is a startup. Anything that you start something new is a startup. It's just this new buzzword of startup has come now is something that we need to understand why it's so. What is the basic difference? One, of course, on the legal technical terminology definitions, we'll read about it. But what I'm trying to understand is that more from the business perspective, what can be a startup and what cannot be a startup, right? Typically, now we all are into valuation here, right? So when it comes to valuation, again, there are multiple nuances of valuation which we'll discuss in detail as we move forward. But when it comes to valuation, there are so many things. Even the valuation side, there could be a technical side of it, which you guys are an expert of, which I am not. But when it comes to practical valuation, no one cares what they on paper. So there's a big, again, disconnect, or I would say two different worlds out together in the startup world, where one is on what do you call it, a paper valuation. On the other side, what do you call as a valuation, where you raise money at X valuation, which we call as pre-money valuation or a post-money valuation, right? Now these two are very different, not so connected worlds, specifically in the startup world. But when I talk about a very large listed entity, which needs a proper valuation exercise, then suddenly the whole theoretical whatever we have learned or whatever Mr. Damodaram has been teaching all of us since ages, right? That comes into play. But that may not be true in a startup world. So we will see all those where are these junction points where we meet, and what are the challenges that we face. So to start with, here is a small slide. I'll just give 45 seconds to all of you to go through this whole flow, how to start a startup. I found this in Google, and this is something that's very interesting which will help us define what is a startup. So assuming that all of you have seen this screen, anyways, it's there online. You can continue viewing it. So if you see, right, I'll just take you through a couple of interesting ones in this slide itself. Like for example, the first and the foremost says someone lives in the future ahead of your time. Basically, what it means, there's a visionary whom we call as founders or promoters, right? Who thinks of the future, where tries to find out what is missing, or basically there's a problem to which they are trying to find a solution which can actually work and it can scale very fast, right? Now, again, these are all, say, for example, you create your beta version, the first prototype version, show it to some 100 odd people, take their feedback, and then we again recreate if there are some changes that needs to be done. We call it product market fit technically in the startup world. So once you have found the PMF, the product market fit, whether what is PMF? PMF is basically the product that I made. Suppose I made an application, I show it to say 1,000 people. Again, those thousands, out of those 1,000, say 200 to 300, maybe my friends and family who would say yes to, yeah, it's a great product just because they like me. But that may not be the true representative of the real feedback from customers or potential customers. But the balance, which when it's a large sample through whom we try to test it, that would actually give us the real feedback on the product. And then we take that feedback, again, keep on working on it, and then finally go back to, with a final product. So that is what we call it, finding the product market fit for the particular product, for that particular application. Now, once we have gone that, then we try to make get users on the platform, start making them pay for it. And finally, if you see this is the most important of which I want all of you to focus on. This says grow 5% a week, which is not an easy task. 5% per week, then you can imagine what kind of growth we are talking here. It's on an annual level. If you see, there are 52 weeks, right? 52 into 5, approximately 250, 300. So that is almost 3x of growth year on year. So I have a lot of friends who run traditional businesses into various different domains. They tell me your startups that you guys help them raise money. What is their top line? What is their turnover? I tell them maybe around 3 crore, 4 crore, 10 crores odd. They say, what's the big deal in that? My business, I do a turnover of 80 crores a year per annum. So why can't you help me raise money? And when you say, okay, that's such a small company with just 4 to 5 crores top line is able to raise money. Then the next question that I ask them, okay, that's great that you're doing such a good business with 80 crore top line, but can you make this 80, 150 crores in the year next, and then make that 150 to 200 crores and then 300 crores in next 3 to 4 years? Answer is no, they cannot, because the whole business is built in such a way, in their case, because it works in a traditional model, which is not that level scalable, which is where they are not able, no investor would be interested in putting money in such a company, which has a stagnant, which has reached its peak, or it would grow with a very limited percentage, say, for example, 5 to 10% year on year. They're not interested. They are interested into a scalable model, which can actually grow exponentially fast, and it keeps on growing so that they make a lot of money, which is where the unit economics, which we'll discuss in later in the later slides, the whole unit economics comes into play. So to me, when you talk about startup, generally startup means any business, any new business that I start, right? That is a startup. But when you talk from an investor's perspective, the whole perception changes. They want to see whether a particular startup is scalable or not. So I would like to redefine the word startup itself by scalability, whether it's a scalable startup or not. If it is a scalable startup and there's a large market out there for it, then definitely there are a team number of investors who are waiting for the money to be put into. Fortunately or unfortunately, when we are young, but yeah, when we were very young, the only source of funding to start a business in India was bank loans, which came against collateral, which everyone could not afford. Hence, there were less number of entrepreneurs in India. But today, there's enough capital available in form of equity investing. Now, these are the guys who are sitting with loads of cash, but they do not know what to do with it. They are looking for opportunities where they can put money. And then there are entrepreneurs with great ideas, but no money, no access to money. So this is where the right marriage happens between these two parties. And finally, there's a funding that happens. So I would say, what is a startup? Whether it's fundable, If it's a fundable, it has to be scalable. So if it is scalable, then it is fundable, which is what I would like to define as a startup. Yeah. So once we have found what we need to do, right? What do we need to, as a business idea, we have found something very interesting. We have tested the beta version. We have found the product market fit. But before that, getting into more on the finance side of it, we need to understand what are the different forms of organization. Now I know all of you are uh, champs of this. I mean, I'll not spend a lot of time on this, but try to see it more from a newbie perspective who is trying to start his business first time. Generally, I've seen all these young founders or young startups, they don't even know what is the best form of organization to start with, whether it should be a proprietorship concern, whether it should be a partnership firm, whether it should be a company, or what does this trust society or a non-profit organizations do. But there are three key important factors for them to evaluate that what is the best form of organization. First is, of course, the legal, right, in which we all keep on advising them on, okay, companies being taken care by the MCA, partnership firm is generally unregistered unless it's an LLP, proprietorship does not have a unique PAN separately, proprietor and the proprietorship concern is all same. Second, tax is a very important again factor to be ensured before taking a decision on what is the best form of organization. Now, the most important critical one, again, moving away from law and taxation, which we all know, is business. Whether that particular business really requires a particular form of organization is very important. Like, for example, there may be a small company or maybe a small group of people who want to start a new entity, but they don't intend to raise money at all immediately. Then probably then you can always advise them that why don't you start with a partnership firm, and later on when you actually plan to raise money, you can convert that into private limited company, because that would help them save a lot of cost in terms of compliance and a lot of filings, etc., with the under the company law. That would be one. Second, there are times like, okay, my business is small, I may not even raise money, but I know that tomorrow, if it's a corporate form, that gives me a leverage in the market in terms of marketability of the company itself. Okay, it's a proper company where I'm a director. I've seen companies where a single person is himself director, he himself is so even I have done that in the past. I know a person who used to carry three different visiting cards for his company. One is a director, one is a I think sales head, and one is a some ops guy. Depending on the meeting how it goes, he used to show. Say for example, where he wants to negotiate more, he would just say, "Sir, this is not in my power. I'm just an employee of this company," and he gives that kind of card. On the other way around, he gets an opportunity where he has to show, okay, he's the boss and he's the decision maker. He gives his director card. "Hey, I'm the director of the company. There's a big team sitting behind me who is working for the company, but it is just a person organization that he's running, right? So from that perspective, that the right. But of course, if someone wants to raise money, a private limited company is the best form, and even investors are not interested in putting money in any other form of organization. They would want to acquire shares of a company which has to be private limited eventually. So that is something very important, to give them the right advice in terms of what is the best form of organization. And this is where the whole relationship with your clients start immediately, that you are advising on the very right front, not trying to make money from day one itself. Idea is to go along with them and then move forward slowly. Then once the company is formed, there are a host of compliances. I'll not get into it. We all know we require PAN, TAN, trade license, SOPs establishment. If you want me to talk on some topic, just let me know. I'm just running through. Professional tax, current bank account has to be opened. It does not end here. India being India, there is a long list of commercial laws to be followed, like PFA said, depending on your employee size. GST has to be taken, import export code has to be taken. Just one nugget on this. Import export code is mandatory for if you are exporting or importing goods. But if you are into services, IEC is not mandatory, but it is advisable, because there are a lot of schemes that the government runs in which you can take a lot of benefits if you are exporting services outside the country, and you get a lot of cashback schemes from the government as well. But for that, you need a IEC code. Then there are FEMA, RBI regulations, SEBI regulations, depending if a company is listed. There are a lot of environmental clearance pollution, specifically for someone who is into manufacturing of certain hazardous goods, etc. There are a lot of licenses like Food company requires a FSSAI license. A medical company would require medical license. Farming company may, if it's into organic, they require organic certificate. In my company, we have taken the organic certification, which is of the highest standard across the country, which is called as NPOP. That certification we have taken, and it's regulated by the government again. Now we'll come to Startup India registration, which Sipa ma'am did speak about initially. So this is something I'm sure a lot of you must be giving those services to your clients. Now, something very interesting on this part is as one of the gentlemen again mentioned that DPIIT registration has certain conditions, that is the startup recognition. But again, this is a bit confusing. People get confused at times. So what is DPIIT registration? What is ATIAC? What is 562? Or as we call it, angel tax in the practical sense. So the first and the foremost criteria for getting a DPIIT registration is the company has to be less than 10 years old. Second, it has to be a private limited company or a partnership firm or an LLP firm. Third, the turnover should be less than 100 crores in any financial year. Then you are eligible to be a to get a DPIIT registration as under the Startup India registration program. Once this has been done, then followed by that, there are various different benefits that you get. Once you get a startup recognition by DPIIT, there are a lot of benefits. Like the first benefit that you get is the tax holiday under ATIAC of the Income Tax Act, which says, I think if I'm not wrong, you get 3 years of tax holidays in the next 10 years of your income. But the biggest challenge in this is that most of the startups are burning money. They are not even making money. They are not profitable. So the tax holiday is not that effective. There are very limited number of companies who are making profit. Like for example, I know Zerodha is one of a profitable company, but then that is not so small. Or Zoho Books is a profitable startup, but again, that is not so small, whose turnover is less than 100 crores. So there very rarely companies are to be found which are less than 100 crores of revenue and making consistent good amount of profit. But yeah, if someone is doing, this is something that one can take up. But again, I have not seen even a single company, at least to my knowledge, who has got this tax holiday benefit, because the process is not so simple. As someone mentioned that getting a DIPP startup recognition is very, very simple. It's a very basic form, basic information needs to be given, though they say, okay, you have to prove it, prove that there's an innovative product, innovative service, etc., etc. But it's typically you just fill up anything and you get that. And you get this registration, I think, in less than 4 to 7 days or so. It's a pure online form and very easy to get. Secondly, when you actually apply for a tax holiday under ATIAC, again from the same portal, then the real question of innovativeness, employment generation, wealth creation comes into play, which is where they try to understand, are you really an innovator? Now, the biggest challenge to that is that who defines what's innovation? You get an idea to me and I say, oh, it's not innovative. I know about it already. But who am I? Am I the right person? Because innovation is something that cannot be defined by law. Say, for example, there is a existing company like Uber or Ola now we have in India, right? Now Uber was already there in US. Now that, yeah, Mr. Deepak, you want to speak?
Sorry to interrupt.
No,
I
no,
just
no.
wanted to know, see, you said this taxation 3-year benefit is rarely availed, but because it's a block of 10 years, see, okay, first 4 years there's going to be a cash burn. So won't it be useful, like from your experience, of course, from the when the section is started, I don't know whether 10 years has gone by, but you know, the later part, won't it be useful?
No, absolutely, it would be useful. When I say it has been rarely availed, I meant it has been rarely granted, not availed. So there are,
Right.
so one, of course, you are right that initial 3 to 4 years, there are very less people who may make profit, but there could be starters who could make profits.
Right.
But by then, either they would have crossed their 100 crores turnover if they're really a scalable startup, funded startup, right? And if it's
Right.
not funded, it's a very small scale that we're talking about, right?
Right.
And then the biggest challenge that I was just coming to is that when you apply for this tax holiday, what in my experience, what I've seen is that there are obscene number of questions being asked on innovation itself, which is the biggest challenge that I was giving that example. Uber was already existing in US. I bring that as an Ola or taxi for sure in India. Now, would you say that's innovation? That may not be an innovation if you see world as one, right? One place. But if you
Right.
see from India perspective, it is innovation. But then the person who is judging or telling you, okay, what is innovation, what is not, it would differ from person. So something which may be innovation for me may not be for you. Now,
Right.
depending on the person who is actually trying to see, okay, or trying to put that checkbox, tick in the checkbox, okay, whether it's a tick, 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 because there are three major criteria. Would you create a large amount of wealth? Would you create enough employment opportunities? And is your idea innovative? Now that all three has a right checkbox, or at least one of them to be really scalable, where they say, okay, now we are going to grant you this tax holiday.
Right.
So it's more on the challenge from the other side rather than, obviously startup would want, right? Even if I'm making 1 rupee also, why should I pay that 25% tax? Yeah, unless I'm not a manufacturing company. So even that 25% is huge. I would want to save that. But that is the biggest challenge on the approval side. It's not so simple. What I've heard. Again, I don't have the exact number. To the best of my knowledge, less than 2% of the cases that they go to them is approved for being an innovative startup, so to say. Though there may be large Sequoia or Axel sitting behind them, pumping funds like crazy, but still they say, okay, no, this is not innovative. So that is the biggest challenge practically.
Right. Thank you.
Yeah.
Actually, can we apply for tax holiday now,
Yes.
but avail it 2-3 years later?
Yeah. So the whole idea is that when you apply, you get 3 years of tax holiday in a 10 years timeline. So even if you apply today, once you get approval, that starts. So maybe, for example, if you're lucky and you have got that tax holiday, you can start that only when the year when you want to start availing the benefit of the tax holiday. So maybe from the 6th, 7th, and 8th years. Yeah, but those 3 years has to be consecutive. So suppose if you start in the 6th year, you get in 6, 7, and 8. So need not that. It's just the application can be done now. But there's a scope of professional opportunity here to learn as well as to try, where the professionals out there who are into this field, specifically into taxation, can actually go and say and work with the clients on a very nominal fee. You can say, okay, for the processing that whatever you will apply, but later on you can agree on a success fee model where you say, okay, if you get a tax holiday, because obviously it's not guaranteed, I take a large chunk of money out of you, right? So I won't want to take that benefit from the clients. You can ask for that. That is something that one can look as an innovative professional service to be given to the clients, because of course you can charge for your basic application form work, etc., very nominal fee, but have a larger fee on the success fee model if that's allowed, again, as per the professional ethics in whatever practice that you are into, right? Now moving forward, there's something very interesting concept called income from other. Yeah.
Suppose if you get the DAPP registration, if you don't get income tax, then we can't take the income tax benefit.
Sorry, I didn't get you, sir. Can you
No,
repeat?
there are two registrations. One is the DAPP registration. The second thing is registration with the IT department.
Mhm.
Suppose if you get the DAPP, as you said, it is an easy process. Income tax,
Yes.
if you don't get it. So what is the benefit of getting DAPP when there is no income tax benefit? Or is it just only kind word, or are there any other benefits for
No,
DAPP
no.
registration without IT?
Yeah. I am coming to that. So there are a lot of benefits. DIPP is just a startup recognition, which is simpler. So today, every company who is starting up, mostly they go for DIPP registration. That is very simple. Post that, there are long list of benefits that I'm just starting with. So tax holiday is one of the benefit that I spoke about. Now there are a lot of. I am coming to that. The second
One
benefit.
question, Rahul,
Yeah.
just one question.
Yeah.
Is outcome-based pricing while offering tax services allowed in India?
No, that's what I said. Depending on the professional institute that you are into, whether your professional ethics allows that would depend. So you'll have to check with your institute. Like, for example, Chartered Accountant Institute does not generally allow a success-based fee. But then
Yeah.
again,
Yeah.
again, it's an association. But I can tell you that there are ways and means of doing it. People have been doing it. They create a separate entity, a private limited company for giving consultancy services, and they do it. Like, for example, even if you go for a investment banking services tomorrow, then you make money only if the startup is able to raise money, right? If they raise enough money from the investor, then it's all successful fee based. So you'll have to clearly chart out a separate division within your organization. If you are a practicing CA, right, then you'll have to figure out the way. But again, as I mentioned, you'll have to check your professional ethics as per your institute. It's not about India, it's about the particular institute that you are associated with.
Also on the approval, no, that generally these 3 years that tax holiday that is not being generally approved because it calls for some IMB interministerial board's approval, and the board doesn't even meet. A lot of practical challenges there in the government. That's what I heard from my professional colleagues. Is it true? What is your take on it?
Yeah. So it's true, sir. When you say that board, right? Again, that's a central board behind this. So DIP Startup India is one portal. Then there's a other party which is income tax, because that is what the benefit that we are getting from the income tax department. Behind these, this is the body that you just mentioned, interministerial board. So that is why I said the person sitting behind this, who is approving these, is something that has to be convinced, okay, this is innovative, which is the biggest challenge. Now, moving forward, there's a section in income tax which talks about tax exemption under 5627B, right? Practically, we call it, in a startup world, we call it as angel tax. Now, if you go to a founder and tell them, hey, I am going to help you get a exemption under section 5627B, the founder would say, what the hell is that? I don't even know that, and I don't care. That is your problem. You solve it for me. Which is where, so we need to understand the startup jargons very well when we are talking to startup founders. Now, there's a full slide in which I'll talk a lot about a lot of jargons, which is very, very critical and important for all of us to understand. Now, one of these jargons is angel tax. Now, what is this angel tax? Let us understand. What is happening today? I start a new company with no turnover, or maybe very small turnover, or say 10 lakh rupees. I go to an angel investor. I tell them, boss, I need money. This is my idea, and I think this is very scalable. Are you ready to finance it? So the angel investor says, okay, I'll give you 1 crore. How much you need? He says 1 CR. They agree on 1 CR, but against what? He says, I will give you 10% of my company against that 1 crore. Which means technically, when I take that 1 crore in cash against 10% of my equity, my valuation of my company becomes 10 crores. Simple math. I've just divided that by 10%. So 10 crore is my valuation of the company. That is the reason I'm giving 10% stake against 1 crore rupees. But if you see the balance sheet of that company, it's nothing. As I said, the turnover is 10 lakhs. So maybe the balance sheet book value per share would be very, very less. Or say my net worth of the company may be somewhere in few lakhs, maybe 15, 20 lakhs or something. But the valuation suddenly has gone up to 10 crores. The challenge that it brings is that income tax says anything that you get more than your fair value. In this case, the fair value is that 20, 30 lakhs, whatever my book value is, that is my fair value. But since you have raised money far more than your valuation, that brings a challenge. Okay, the income tax rule says that becomes an income for you, for the company, and you have to pay tax on that, which is not true technically. For that, the government came up with an exception which says, okay, you will get an angel tax exemption with certain, of course, conditions, till the time the money that you have raised is less than 25 crores. And it is being invested by individual angel investors, Indian angel investors. Any money that you raise from a non-resident that is not covered under section 56. That does not become an income under 56, section 56. But if anything that you raise from Indian, so specifically from the angels, that is where you get an exemption, but up to the limit of 25 crores of cash raised in that company, which is where this exemption. So one benefit, which is a very critical benefit in this DIPP registration, is that as soon as you get the DIPP recognition and you apply for this exemption, this I might have actually helped more than 50 companies to get this angel tax exemption certificate. And this is very easy. Simple form has to be filled, and you get that in, I would say, within 3 to 4 days itself. In your email, you'll get an exemption certificate in your email. That easy. And once you have got that, then whatever money you raise, till the time you have raised 25 crores in cash from the angels, it's not taxed. Most interesting part is that you can apply for this at any point of time, and it will be effective from the date of your incorporation. Suppose a company is formed and I apply this after 4 years, even today, suppose the company is already existing, still you get that from your date of incorporation, but only in those cases you will not get where they have already given some scrutiny notice, or some questions have been raised on your valuation or on your fundraise past angel fund round that you have done, that will not be covered in that exemption certificate. Rest all will be covered. So very
Rahul,
interesting.
one question here.
Yeah.
Now, in the recent budget proposals, even NRIs are supposed to be covered under this, right? So, what happens, assuming that let's say this budget proposal do get passed and it becomes a law, all right? The same, if somebody already has that exemption, will NRI investors also start coming under the ambit and can this would start applying to them also?
No, I'm not sure of the budget proposal because I've not gone through that, to be very frank. But having said that, Section 56 is not applicable for non-residents any which ways.
That is where the law stood before these budget proposals, and that is
Okay.
that is an amendment that has been proposed.
Okay.
So
Okay.
Yeah,
if it
yeah,
becomes a
this
law,
NRA have been included here now.
Yeah,
Now
now
Okay.
they have
in
been
current
included.
budget, it is included.
Correct. Yeah.
Once it is passed, the same 25 crores criteria will apply to them also.
Yeah, but what is not clear is it for new investments made after the current budget proposal become an act, or would it apply to any investment that have been made prior since
Should
the
be
inception of
prospective
the
only.
Prospective
Budget
only.
proposal should be
Okay.
prospective only.
Okay.
See, generally, any new law that comes, right, any changes, amendment in the Income Tax Act, it has to be prospective, because you cannot tax something what has already been done. So obviously, it should be. Again, I concur to that view. And plus, these new money that is coming in, and I'm assuming that even under this angel tax exemption, that would be covered up to 25 crores with all the conditions and criteria.
So it means if
One
somebody is
in-
trying to apply for an exemption, one might as well wait out till the budget proposals get passed, because the new ones are more beneficial, right? To cover both the NREs as well as domestic individuals, right?
I'm not very sure on that part, but I think even the existing the certificate that they've got, right? Because that probably this exemption would come as a clause within that section itself. And when
So
these when the
that would effectively make
certificate-
it retrospective
Exactly.
operation as well. Yeah, correct.
Correct, right. So when they give
Yeah,
a certificate, right, in the email that you get the certificate, they just mention under this section and so clause, you are covered. So by
Okay.
default, if there's a change in, by default, that exemption will be
Okay. So what we have to look out for is if the clause is different, then perhaps one might have to apply again.
Exactly. Maybe. I don't, that will time will tell us. We
just
don't have an
just to add here, the way it goes is it says up to 25 crores. You have to exclude NRA investments, and only resident investments are come within that ambit, and they provide that exemption. Now, once they start including NRI, they will also make an amendment to the notification whereby the 25 crore threshold would include NRI as well as resident. So we would actually, the startup would not stand to benefit because the amount of fundraise that happens from NRI.
Maithili, you went on mute, Maithili.
What happens is 25 crores is nothing. They will just raise money. So after every 25 crores, all valuations will have to be supported by merchant bank valuation, and it has to justify the pricing.
So I think that's a very good point, Maithili. I think that could be one of the reasons. That's the reason we call it angel tax exemption, right? It has to be from angels. Where if in the name of individuals, if someone is getting loads and loads of money, a huge amount of money, that ideally should not be covered. Then that should be justified by that. I think logically it stands very well of what you're saying. Right. One more very important.
One small point. So one will be able to avail this angel tax benefit if they have registered under DPIIT, right?
Yes.
So as you said, getting that registration is so difficult. So
No, it's not. So I'll just clarify. Getting
Okay,
this startup recognition is very easy. Getting this tax holiday is tough, I'm saying. So once
so
you are
tax
startup
holiday
recognized,
is for the innovative startup, all those things, which is the tough one you said.
yes.
And that is for ATIAC, that one you said, right?
Right.
ATIAC income tax exemption is tough, but what you told us is the angel tax is not all that tough. It is relatively simpler.
So let me
Once you have
rephrase the whole thing.
DPIIT, you will be able to avail angel tax. Okay, that is
Yes.
that is
correct.
fine.
Let me re-clarify.
Yeah,
First step, once the company is formed, first step is to take the DPIIT registration, which is very simple. Almost everyone gets it. Once you have got this, there are n number of benefits that you get as a recognized startup. One among them is tax holiday, which is tough. Second among them is angel tax exemption, which is again simple and easy to get done. And plus there are more benefits, which I'll just cover in some time. One last point on angel tax.
Mr.
Mr.
Rahul.
Rahul.
Yeah.
For this angel tax also, we have to apply a separate application, or is a part of initial recognition?
No, separate application.
That is easy.
Yeah, it's a simple process. Simple one declaration has to be given, uploaded in the website, and you get that. Very simple. It's less than 5 minutes job.
This 25 crores, can you just repeat, like what exactly is 25 crores? Existing paid up plus share premium?
So total money raised in the company in cash, not the valuation. In my example, it is 1 crore at a valuation of 10 crores. I'm not talking about 10 crores. I'm talking about the cash raised. Till the time total money raised does not cross 25 crores, you can still continue availing angel tax exemption. And that 25 crores is excluding non-residents or any VC investors as well.
Okay.
Basically from the angels.
And who is a VC investor? He should have a SEBI registration.
So
as a VC.
there's a clear definition under this section itself, which says, I think if I'm not AIF category 1 and 2, those kind of people who are registered SEBI as a VC investor.
So SEBI AIF registration certification, if we get, then we are sure that yes, it is exempt.
I'm not going to exact law, definitely that you'll have to check the section, but yeah, conceptually we are on the same page. Right. One more very important criteria for being an angel, getting this angel tax exemption, is that the company cannot invest in assets like land and building and securities. Now, this is a major catch here. Securities. Securities means all units, all shares. So that company should not hold any shares of any other company, even a private limited company. That company should not be investing in mutual funds, because even in that, so generally companies, when they raise money, they have idle cash sitting in their books, right? What do they do with that? Of course, they are not allowed to invest in equity mutual fund, but they do take the benefit of debt mutual funds. Now, these debt mutual funds also issue units. So you cannot invest in debt mutual funds as well. These are very important criteria, and one needs to be sure of, as a professional, we need to advise them that you cannot do that. What you can do is only put your money in bank FDs. That is best, or maybe some corporate FDs if it's allowed, but it should not be a security when they issue as per the securities law. These are very, very important criteria which people tend to forget when they apply for angel tax exemption. And this is what the declaration is required for. Yeah.
Now, just a question on this. So basically, if the company got established and before raising the fund from angels, they got their subsidiaries in place, and then they are raising the fund. So whether we can say that, okay, I'm not using the, basically I have set up the subsidiary before raising the funds, and hence I'm not investing the amount which I'm getting from angels in the subsidiaries. Because will that be okay?
I'm not sure. Your question is valid, but I think I'll have to check and get back on that.
Okay, thanks.
Yeah.
One more question.
Yes, sir.
When we enter issue the further this startups to the share, there will get income tax benefit, angel tax, where you will get the no restriction premium. But at the same time, when under the Companies Act, any issue of share to the other than promoters, it requires a valuation report. So when shares are allotting under Companies Act, in any case, a valuation report required from the IBB registered valuer, and what they giving benefit is income tax. So the challenge holds good for the same company, then where they cannot justify. So
I would request you to park this question for some time, because I know this question would come, and when we'll discuss the whole valuations piece, right, technically and again practically, that time I think we should discuss it, because I'm sure there will be too many questions on this, because this is like your forte. I would love to understand from you guys what is the best solution. I tell you what is happening today practically as well in the startup world. Right. Let's move forward. So once you are DIPP registered, there are further benefits that you get. So someone was asking that what are the other benefits that we can get? These are the benefits. So if someone applies for any trademark, being a DIPP registered, you just need to use that DIPP number. You get a 50% discount on the fees. If I'm not wrong, a company has to pay 9,000 rupees for per trademark application, per class, per trademark application. That you get for 4,500 only, 50% straight away discount. No questions asked, just use your DIPP number for that.
That first stage is permitted, first stage certificate.
Yeah, just DIPP recognition itself. These all are parts of benefits of being a DIPP registered startup. Second, if you want to apply for patent, which a lot of new tech companies do, you get up to 80% discount on the fees. But the challenge here is that patent fees is not very expensive. The lawyer's fees is very, very expensive. That obviously you won't get the benefit. So, but still, whatever you get, at least you're getting something, some benefit there, because the patent fees is not that very high for a company who is actually trying to apply for patent. The next benefit is that generally I understand for closing down a company under company law takes a long period of time. If I'm not wrong, theoretically, that at least you have to show 1 year without any assets and liabilities, continue that without any income, and then you apply for that form for winding up, etc. And it's a long drawn process. It says theoretically, at least in if you are DIPP registered startup, then you can go for winding up under IBC 2016, that is the Insolvency and Bankruptcy Code. Again, this is where professors like you can help. Again, I am not an expert. I have not done this practically myself, but this is what would love to understand if any one of you here has done this, wound up a company within 90 days under IBC, would be great to be shared with everyone.
Rahul,
Yeah.
I think it's winding up under for startup, which was, I think this looks like an earlier provision. Now all winding ups are provided on 90 days time only. So there is a change in the timelines, the last budget.
Under company law itself?
Under the IBC law. What they said is, earlier the time limit for 270 days was there. Now they made, if the company has no creditors, whether startup or non-startup company, then they can complete within 90 days. I hope they need to complete. If they're not able to make, they have to give justification.
Okay, great. And in that case, one more question. Say, for example, there are creditors in the books, and plus there is some money also there or some assets are there. Then do we still get a insolvency professional appointed, and he will help us, he or she will help us liquidate the whole asset and then go for a winding up?
What is your question? I didn't get.
Hello?
What is your question now? I didn't get.
So I'm asking, suppose there is a company in which creditors are there in the balance sheet, and plus there are assets in the company. Do we need to appoint an insolvency professional who will liquidate everything and then go for winding up?
Correct. Normally, whether creditors are there or not there, if they want to go for voluntary winding up, only condition is a declaration of solvency. Company should be able to meet all its obligations. So what they made is, earlier the timelines were more. Now they reduced to, if there are no creditors, within 90 days they have to complete. If there are creditors, it is a 270 days.
Okay.
Yeah.
Sure. Thank you so much. And then further, the next benefit that you get as a DIPP registered startup on the labor laws. So a lot of, so there are a team number of labor laws in India. Still, we have not seen the new labor code coming to see the light of the day. But currently, there's so many labor laws. You get the benefit of self-certification up to 3 years for multiple, all different labor laws. You just keep on self-certifying yourself, and there's no question unless there's a grave fraud kind of process where they get to know, okay, startup is not following something, etc. Otherwise, it's just based on the self-certification itself. Yeah. So these are the benefits of.
Sir, one question, sir.
Yes, sir.
Any specific procedure to be followed for the self-certification like PF or ESI? Should we file a declaration or it is automatic?
So I would suggest, I have not done that practically, but this is one of the benefits. I would suggest if you go to Startup India, this link I've already shared, startupindia.gov.in. There they said give the very clear-cut process, step by step, what needs to be done. So you'll have to check it in that portal.
Thank you, sir.
Yeah, thank you.
Actually, Mr. Rahul, I got stuck in that 25 crores thing. When you are calculating 25 crores, all the VC fund has to be removed, right, for that 25 crores?
Yes.
Okay.
Because I'll tell you, if there's a small company who has a turnover of say 50 crores, right, you are still eligible for that, but you have raised money some from VC as well. Then what would happen? This exemption is only for the angels. Now that VC portion is not exempted, but at least from the VC angel perspective, you have to give them that exemption. That is the reason they put that criteria. That from individuals, if you have because raising up to $1 million is no big deal, even from individuals, right? People do raise that kind of money. So if they're raising $1 million, $2 million, still they want to give that benefit to them. Now, so a lot of you have asked a lot of technical questions. I had expected that, but again, I have kept myself away since some time in terms of technicalities, right? Because though I keep reading, but since the time I've gotten into business now, running my own startup, that's the reason I could not answer some of the technical questions. But yeah, I'll try to find those answers and get back to you through Silpa, and so that we can get those answers as well. But yeah, of late I've not been so much of into deep technical reading. That's the reason I was very frank and open that okay, I don't know that, and I'm very clear about it. But I want to more talk about business, right? I think it's now 8:30. We have another hour or so. And I'll try to cover now. This is the most interesting part that I wanted to share with you all, right? My experience in terms of startups and fundraising. Now, to start that, the first and the foremost important thing is the understanding jargons. As I mentioned, when you talk to someone, if you don't talk their language, you don't connect. And to connect, you need to start talking in their language so that there's a very interesting and smooth flow or exchange of information. So there's a lot of jargons that I would like to speak on. Like one is B2C and B2B. When I say B2C and B2B, again, generally in a professional forum, the first thought everyone gets is that whether it is GST registered or not. Okay, if it is GST registered, it's a B2B transaction. If it's with a non-GST registered, it's a B2C transaction. But I'm not talking about GST. I'm not talking about any law here. I'm talking about pure business models here. So there are multiple business models in the startup world, which is known as B2C, B2B, B2B2C, B2G, basically business to consumer, business to business. So very important, and the fundamental understanding of any particular model, revenue model, is to understand in a particular startup is whether it's B2C or B2B. So again, I'm assuming you have got the sense what I'm trying to say. Since it's a jargon, so that's why I put it here. If you want me to deep dive, let me know. Otherwise, I'll just move forward. Then there's something called cap table. There's something called CCPS. I'm sure being in valuation, most of you know about this. A cap table is something which clearly defines what is the number of shares that each investor or each shareholder holds, and then it tells you, okay, this is the percentage ownership of the particular investor or shareholder in the company. That is what a cap table is. Then cash burn, we all have heard continuously that startups are burning money, cash burn, etc. This is a very interesting and very important jargon in the startup world. What cash burn literally means, technically, is total money cash inflow that you get minus the total cash outflow that a company does is called the cash burn. So basically, it's net cash outflow of a company, net of even the revenue, that little revenue that you may be making. That is what is called as cash burn. Now, technically, generally in a startup world, we measure cash burn on a monthly basis. So what is the cash burn on a per month basis? What is the reason behind that? So one term, I'm just seeing if I have it here. No, it's not here. So there is one more term called runway. Now, what is runway? Suppose I have 1 crore cash in my bank, and my per month cash burn is 10 lakhs per month, which means I can survive with the current cash in bank for next 10 months. So I call that runway. Runway is one more jargon, which is like I have a 10 months runway left in my company. This is a very important term or metric that every startup and every investor continues to follow. Moving forward, I'll just continue. If someone has a question, please stop. Cohort analysis.
I have a question.
Yes, sir.
Raj here. So recently in one of the forum, I heard VC saying that about cash burn especially. If somebody was talking about cash burn, and he said that what is cash burn? Nowadays, we are moving away from cash burn, and you should show profits and stuff like that. So
Yes.
is that true? Number one. Number two is, if cash burn is something VC or angel is allowing, like how do they do it actually? What is the confidence level through which they are ready to do cash burn? Like if you see Crate and Zomato and all, I mean, it's huge cash burn happening. And why do they do it actually? Is there any other intent from the VC? They want to really, I mean, save their black money or something like that. I don't know. What is that underlying intent of allowing the cash burn happen? There are two questions here.
Yeah, sure. So that's a very interesting question, right? And I think every time I sit with my dad, he's a traditional businessman. We have this kind of discussion. He said, I don't understand your world. What is happening? All this All these companies are like crazily burning money, and then they say, okay, we are a proud businessman, we have done so great, right? Now let us understand what happens behind the scene. Now, as I mentioned initially, right, there's a large number of people sitting with huge cash, but they don't know what to do with the cash. Like, for example, there's a billionaire whose son is obviously born millionaire with a golden spoon, or I don't know if it's a diamond spoon. Now he's sitting with a lot of billion dollars. Now he does not know what to do with that cash, right? He does not know how to run a business. He has to put some money somewhere. And then there, on the other side, there are ideas, there are entrepreneurs who has great ideas, who is very passionate and want to work very hard, but he or she does not have that right kind of money, which is where these two people come together. Now, how these people come together? Now, this guy who with the rich guy, he does not know how will he go and start scouting so many startups, right? Which is the best startup to work with. So there are a lot of funds that come up, like for example, which we call it a VC or a P, venture capitalist or a private equity. We'll understand that also. Who are they? Now, these funds, they create a pool of fund, raise money from these. It could be individuals, it could be different organizations, etc., who put money. We call them LPs. LPs means limited partners. These are limited partners. Then there's a general partner, GP. GP and LP, they together create a fund in which LPs are just investors in that fund. The GPs, along with their other professional managers, they create a small team in which we call them partner, principal, associate, etc. They start analyzing, understanding. Now they have a mandate from their LPs. As a fund, I need to create X returns for the investors, which is where I get my. So even the partners of these funds, they are all salaried people who take money based on, one, they get salary, of course, for running that business, that investment business. Second, they get money which is very clearly defined based on the success ratio. So if they make X percentage, this is they call it, if I'm not wrong, they call it some threshold. I forgot the name. Based on hurdle rate. Yeah, it's called a hurdle rate. So if they make over and above this, this is the percentage of the money that these guys will get, because for finding the right opportunity, it's just like a mutual fund manager, right? Now, when they have to invest, they are scouting for so many ideas, right? Now, these are all, just see it as a, since you asked this question, if you are active in the stock market, just see it as a small cap company. A small cap company, which can be a hero or it can be a zero. Now, if you invest in a small cap company, there's a very, very small company, there's a high chance that it may go bust, or there's a high chance it may give you multi-fold returns, which is what the game that these guys are playing. They invest in, say, 20 companies, they identify 20 companies, they first make a thesis. Okay, I am going to invest in such kind of B2C companies. I'm going to invest in B2C tech companies, or it could be, I am only interested in B2B so and so. And that is based on that theme, they raise money from the LPs. Once that money has come, they will start talking to multiple startups. Now, suppose they have invested in 20 startups, 1 million each, $20 million has been invested. That is what they had raised. Suppose there was a fund of 30 million, 20 million they invested. They know for a fact, no one is sure of which company would work and which one not, right? But they will take their best guess. Okay, this is a good model, there's a large market, team is good, blah, blah, blah. There are a lot of criteria, and let's put money. But they know for a matter of fact, out of that 20 companies, only 2 is going to become super successful, which may reach to a $100 million valuation, or a 500 million, or $1 billion as well. Maybe one of them out of 20 may get to $1 billion valuation, but rest 18 would just go bust. I'm not expecting any return from them. Now, with that, what is happening? Out of those 2 or 3 successful companies, or maybe 2 is super successful, 3 is so somewhat successful, maybe 2x, 3x return, but that 2 has given me 40x, 50x, 100x return of the money that I put. That 1 million became, say, for example, 40 million. And whereas others have just gone. So out of that 20 million that I put, if I make a money of, suppose, for example, almost 40 million overall of my portfolio at a portfolio level, I see on an annualized level in a 5 to 6 years time, I make a IRR of 40%, which is a good handsome return that they're targeting. And 40% IRR is a significant business return in any business or any investment. I'm talking about IRR, right? So that is the idea, that they are not giving money to only burn, but they're taking a bet on different business models where they see, okay, if this particular business scales, then definitely this will go to a very different level. Then how do they make money? Since and why, and there's one slide in which we'll discuss on the unit economics, which is very, very important, is that they are mostly interested into passing on their investment to someone else. They're here for making capital gains, not really to invest in a profitable startup. If you go with a profitable startup, Without scale, they are not interested. If they go to a large scalable startup which is profitable as well, they're super interested. But if you go to them with a very scalable model, or you show them that okay, traction is really well, but it's losing money today, but tomorrow it can actually make a lot of money, which is where they're okay to let the startup burn them.
So what you are saying is they will analyze in such a way that how well they can exit. They can exit, and somebody else will come in, similar person will come in and invest there. It is somewhat like stock market only. It is a bit of a gamble actually.
It is called the bigger fool theory.
Yeah. So when you say like a stock market, right? Absolutely right. So the only difference is that in the stock market, it's a large number of shareholders, public shareholders. So, but this is more like a private stock market, you can call it. Ultimately, even they are trying to create value, increase the valuation of the company, which in turn increase the price per share, and then you try to exit and do a secondary sale to someone else. Ultimate, that is where we see today so many young startups, right? Like Paytm, Nykaa, Zomato, they got listed. Now, convincing a small group of people in a private setting or in a room is very easy because there are less number of heads. When it goes to public market, there are huge number of shareholders, analysts, etc., sitting and trying to price you, trying to find the right valuation of your company, which is where all of these stocks got a beating. All of these got stocks. But what at the prices that these got listed today, most of them are at somewhere around 25 to 30% of what they got listed, or maybe around 40%. So that's a huge beating. But who made money? The early investors who actually offloaded their shares during an IPO. It was most, if you see, these were not a primary issue where the company is getting. It was mostly like a just secondary sale. They're trying to get an exit through an IPO. So all these retail shareholders, because SEBI has a norm where if you have to get your company listed, at least 25% has to be held by public, that is non-promoters, which is where they offloaded all their shares and they took their money and went out at that high valuation. And all the retail investors who got stuck at that high valuation today are still holding that and crying, or they might have booked their losses. And now, quarter on quarter, when these companies are posting results, depending on that fluctuation. Like for example, just a disclaimer: I am an investor in Zomato, I am an investor in Paytm, but I did not invest in the IPO. I was very clear this is an insane valuation. But when it went down today, if you ask me, I do both fundamental investing, I do trading as well. But am I a fundamental investor in both Paytm and Zomato? Absolutely not. Still, I don't believe in that because a loss-making company in the long run cannot create value for me. But I have become a trader in that. I know it's such a low valuation today. Every quarter they are showing slight improvement because market always works on a forward multiple basis. They see, okay, after 2 years, this may create value. So let's buy. And then again, there's some news comes, again, it goes down by 10, 20%. So which is where some kind of trading can be done. Yeah. So I'll just continue. Cohort analysis is something that where we break the data into very detailed cohorts, and then we do some kind of analysis. I'll not speak much on that because not that relevant. What is the CAC? Customer acquisition cost. Basically, every time you try to get a consumer, you spend something, right? That is the reason we get so much of cashbacks or referral bonus. That is something we call as customer acquisition cost. It's defined based on per customer that is coming on my platform, how much money that I spend, be it digital marketing, be it cashback, be it referral bonus, etc., that I spend on getting that particular customer on board. We define cap table. What is a fully diluted cap table? A cap table may have various different instruments. Say, for example, CCPS, which may have a different conversion ratio. It could have a convertible debentures. It could have a ESOP pool, which further dilutes the ownership of a company, company shareholders, which is what we call as fully diluted cap table, which is again, generally when we present to investors or when we put in a document called SHA, we put a fully diluted cap table only. LTV, very interesting term. It's called lifetime value of a customer. What is the lifetime value? A particular customer coming on my platform, there is an estimation which is called as how much money can I earn from this particular customer in its lifetime. What is lifetime? Now, lifetime cannot be defined, right? Say, for example, in Netflix, the history says Netflix users Generally, once they onboard, once they take a subscription, typically average life of a particular user is say 6 months minimum. So they stay for 6 months and then they drop out. Then again, that user has to be acquired back. That is called a lifetime. So depending on every startup, every company, we need to define what is the lifetime first, and then lifetime value. Suppose in my example, suppose Netflix sees historically a particular user stays with me for at least 6 months, on an average 6 months. That means lifetime value is 6 months, and my per month subscription is say $10. So $60 is my lifetime value of that customer. So I can make at least $60 from that particular customer. MVP, minimum viable product, that is the beta version before launching that we create. PMF, I've already told, product market fit. Traction is again, when you see a hair traction, it sounds what is traction, but typically I tell you traction is just that whether there are numbers flowing or not. Traction could be of revenue, traction could be of new users, traction could be of, so technically when we speak in a startup world, we say, do you see traction? Do you see new users coming up? Do you see existing users being active? Do you see sales numbers coming up? Do you see traction in revenue? So traction is a common word where you see, okay, whether there is a movement or not, and it can be used with multiple different adverbs. Unit economics, it's a very interesting concept. I'll cover that in one of the slides. Valuation, pre-money and post-money. This is something I want to spend some time for now, and then we'll discuss further. What is pre-money and what is post-money? Suppose in my example, I had told that 1 crore we raised at a 10 crore valuation. That is the post-money valuation of the company. Now, what is pre-money? If I subtract the cash coming in the bank, that is 10 minus 1 crore, that becomes my pre-money. So basically, pre-money and post-money is just the difference between the cash inflow in the company. Suppose, another example, suppose I say my pre-money valuation of the company is 50 crores and I'm raising 5 crores in the company. My post-money valuation becomes 55 crores. 50 plus 5, 55 crores. Now, we'll not discuss on this much into deeper. This was just a definition. I'll not take questions right now. When we discuss valuation, then we will take it. I know there would be n number of questions. What is a term sheet? Term sheet is a basic document. It's a non-binding agreement between the investor and the investee. So before getting, so based on the, suppose I'm presenting to the investors, I tell them, okay, this is the money that I want to raise. Basic major terms, valuation, amount that we put in, what kind of instruments, any conditions that are there. We agree on a terms, we sign a term sheet. Term sheet is generally subject to due diligence. Once the term sheet is signed, the DD starts. Post that, if the DD fails, then they may just pull back the term sheet. They said, oh, we are not interested in investing. That is the reason I said generally term sheets are non-binding in nature. It's not something that is mandatory. Okay, if you have signed a term sheet, then they are going to invest in your company. Angel, PE, VC, these terms, I'll just take you to this slide is something very interesting that will tell you the whole journey. We keep on hearing, right? Series A, Series B, Series D, Series F, and up to Series Z, right? So these are so you see initial seed capital. So these are again jargons. Don't get bogged down if someone tells you, I have raised seed capital, or someone says I have raised angel money, I have raised. These are all different synonyms being used by different people at different stages. They know legal law that defines these terms. It's just practically people keep on using interchangeably. So again, nothing to be thought of. Okay, this, if a particular person is saying I have raised seed money, that means okay, he might have raised only a small money. Then need not be. There are large companies who might have. There are companies who have raised seed money as high as multi-million dollars, of $15 million, $20 million as well. So it's just a term which is not defined anywhere. It all depends on the particular company itself. First, initial capital is called seed capital. That's why it's called seed, where you बीज बोते हैं एक पौधे का. Who are the investors? Angels. Angels are individuals, HNIs, ultra HNIs who have a lot of money, but they write small checks, maybe starting from 5 lakhs to 25 lakhs to 50 lakhs or maybe 1 crore. FNF is friends and family. Only friends and family would trust in you when you start a new company, which is where they try to raise their first money. A company who has not raised any money and started their own business by the money being put by only the founders is called bootstrapped, where they own the 100% equity by themselves. So the term that we use for that is called bootstrapped. Once they have sown some business, so this portion is called value of death. Generally, they say till the time you don't raise your first VC check, you are still in the valley of death. There's a high chance. There are a lot of companies, and it's true as well. There are a lot of companies. We only hear the success stories in the newspapers, in the articles, but we don't hear about hear about failures. And I will tell you, 95% of the startups just fail, which are not celebrated. So we don't know about that, right? So that's the reason this is called as valley of death. Most of the startups die here. Once someone has raised a kind of money from a VC, then they get enough cash or enough validation. Okay, there is someone who's ready to write large checks in my company, which can agree. Further, as we move forward, valuation increases. We get into Series A, Series B, Series C. Again, these are terms that we define. There's no one who defines these. We have even defined in certain companies. I've advised people to define calling it as Series A1, Series A2, Series A3 before going to Series B, depending on the kind of level that you are into. What is the difference between VC and a PE? VC is called venture capitalist. These are small investors, right? Small checks. Small checks could be as small as $1 million. It could be as small as $150 million, but still it could be a VC. A private equity generally wants to take a controlling stake, very high stake, 40%, 20%, 50%, large checks. Generally, PEs want to get an exit through an IPO because they know one above PE, unless there's a large M&A, like Flipkart was acquired by this kind of US company. I'm forgetting the name. So Walmart. Yes, Walmart. So Walmart acquired Flipkart. That was a M&A. But generally, PEs get an exit through. And so how do angels get an exit? Angels put money at a very early stage. They are the first ones who actually back a founder. They get an exit when a VC comes in. They get an opportunity to exit and give their shares to the VCs. VCs get an exit when they give it to PE. Or again, VC and PE is an interchangeable word. In the practical world, when we say VC, it does not mean technical VC. It's a technical definition. VCs are small investors. But when we say VC, even to a PE, we call it VC only. Finally, there's an IPO, or there could be a secondary sale, etc. What we discussed. Any questions on this?
Again, what is the difference between VC and PE? We call it, is it interchangeable?
Yeah. Practically, it is interchangeable. Theoretically, VCs are early stage who take small percentage of the company, write smaller checks. PEs are more deeper with more deeper pockets than VCs. And PE generally want to take a controlling stake in the as high as it could be 20 to 40% to 60% as well.
When you say Series A, B, and C, is it defined based on the valuation or is it based on the check that has been written by the investors?
So that's what I said. Theoretically, it's not, there's no definition per se. It all depends on company to company. I have seen Series A's happening at 25 million, it happening at 1 million, happening at 200 million as well. So it all depends on a company and a VC. They decided to say, okay, how should I name it and what should I name it?
One more question. When you say Series A, B, do you expect a certain maturity with regard to the product, whether it is like beta testing is over or whether it's ready for launch to market? Is there any kind of a threshold or a thumb rule that we use for that, or is it very loosely based? It could still be ideation in A, B, or I believe at least A or B, you should have a product which is ready to launch to market, right?
So it's the other way around. So in fact, it's the other way around. See, generally, when do you call a round, right? As a Series ABC, obviously the valuation has to go up, right? When the valuation goes up, more money is coming in. So that is actually the outcome or the byproduct of what has happened in the past. Now, if there's no market product maturity, if there's not enough revenue, they're not scaling up, there wouldn't be any VC who will be willing to put more money into that company. So it's by default, by design itself, Series A, B, C is basically which clearly tells you, okay, you are raising more money at a higher valuation. There are cases where the money has gone down as well, where people have raised money at a lower valuation, which we call as a down round. It's one of the jargon used in the industry. We call it a down round, where the down round. So down round is seen as a very, very bad, I would say, outcome of a company. Okay, it's not in the right phase. It's going very bad for them. So generally, A, B, C, even if it goes to Z, ultimately it means that, okay, it's raising more money, or maybe if not more money, similar money at a much larger valuation. That is giving up lesser stake in the company, diluting very less, which obviously would only come when you have higher revenues, higher cash flows, better profitability, scalability, etc., product market fit, etc. Yeah.
Rahul,
So yeah. Yes, sir.
one question. So when we talk about CCPS or ICF notes, so is it that it will be generally used only at the time of seed capital, like angels and family round, and from VCs they use equity only? Your take
No,
on
no,
this?
no. In fact, it's the other way around. Generally, all the VCs insist for CCPS. Equity
Okay.
is something. So when we raise the first money from the angels, again, depending on how large is the angel round, it's a very small few crores. What we advise is that, boss, just let's issue equity and let it be there, right?
Okay.
Second, when large VCs come in, they insist on having issuing a CCPS, because CCPS has, being a preferential share, has a higher right. Plus, we will discuss on certain terms. There is something called liquidation preference. Now,
Yes.
obviously, one liquidation preference is something that they get on the winding up of the company, but that's not the intention, right? They don't want the company to be closed.
Absolutely.
But
Yeah.
where the liquidation preference is really helpful is that if there's such a scenario comes, they have a certain criteria, a clause in the SHA which says, suppose I have a lick pref of 2x. So suppose tomorrow if the company, if that case comes, the first and the foremost right I'll have, and whatever money, the cash that I put, at least I get 2x of that, and then the balance would be shared among all the shareholders. So by CCPS, again, it's a compulsory convertible. So you have a lick pref rights. Simultaneously, you get the benefit of being an equity shareholder as well. But simultaneously, practically what I've seen, all these VCs insist on holding at least 1 or 100 equity share as well. They say that under company law, if you are equity holder, you have a better rights, etc., etc. Though now it's all gone, because whatever we write in the SHA is copy pasted in a AOA of the company. So by technically, legally, it's all a part of the company bylaws itself. But still they insist, because traditionally it has been going on. A lot of VCs say, at least I'll take, okay, if I am putting 10 crores, issue CCPS to me with my rights, etc. Plus I'll take 100 shares of equity as well for namesake.
Okay. Okay.
So by that methodology or logic, won't OCPS be better than CCPS?
I think there are some certain this right. In case of OCPS, there are a lot of conditions that are required to be met. I think even company law does not allow OCPS so easily, if I'm not wrong. Because in case of OCPS, it's not. I would say it still may not be an equity, right? Then you can always say it's a kind of a debt where you will have to pay back the money. So it becomes a technical challenging, and even the next investors is something that they may not like it. So that's the reason practically mostly CCP is something is the standard acceptable instrument across the world today.
Okay. Okay.
Yeah, I'll move forward. This I'll try to cover very quickly. What are the steps that goes into fundraise? In the interest of time, we are already at 9 right now. We have half an hour, but yeah. What does it take to raise money, right? It's not easy. I'll tell you, it's pure play a sales job, completely a sales job. Okay, someone is asking what are safe notes. I'll answer that. So there are various instruments that have come in, right? So you can issue, as I mentioned, CCPS, you can issue equity shares as well. Now there are a lot of the new technologies. So safe note is a concept that started in US, which is called as a simple agreement for future equity, right? So there are cases where a company is trying to raise money from a very small micro VC or maybe a small angel investors or sorts, but they are not sure how to value that company because it's a new age company, very new company, business model has not, a product market fit has not come. So in that case, what they do, they issue a note called safe note. So simple agreement, it's a simple 2-3 pager agreement which says, okay, boss, I'm putting 1 crore in your company, but I do not know what will happen to this, what round you are going to raise money at. So we will do one thing, we'll do an agreement among ourselves, in which we'll say in the future, next round, whenever you raise money from a professional investor, be it a VC or someone who knows better to value your company or do the valuation exercise, etc., that is better negotiation than me. But I don't understand this valuation thing, but I know I am ready to fund you because I like you, I like your business idea. In that case, safe note comes into play with a clear-cut condition that I am going to get shares based on the future round of valuation with certain discount. Say, for example, today I'm putting 1 crore, but I'm putting money today in your company. Tomorrow, when you raise money, Suppose, and my expectation was, say, let's assume I wanted 10% of the company, but tomorrow you are raising money at a 20 crore valuation, which is far higher. So my 1 crore of 20 crore, I'll get only 5% equity rather than 10. So from that perspective, I say, okay, whatever valuation you raise, I'm going to take a discount on that valuation and I'm going to get equity. Say, for example, tomorrow the company is raising money at a 20 crore valuation and there's an agreed discount of say 20%. So for me, the valuation becomes 16 crores and I get equity worth of 1 crore by 16 crores rather than 20 crores. That is something called a safe note. Secondly, there are further improvisation of this.
Rahul, sorry to disturb. So safe notes, how does it appear in balance sheet?
Nataraj sir, just let me complete it once. So there are further improvisations of this where one can say, okay, I have put this money, okay, with a discount of the future, in case of the future. In that case, there can be a floor and a capping as well, where I say, okay, minimum valuation is 5 crores, capping valuation is 20 crores. So because tomorrow, suppose if the company straight away goes for a 50 crore down, 50 crore down, with my that limited discount of 20%, I will get at a 40 crore, which is my expectation is gone completely because I wanted more equity in the company. So I can have a floor and cap, say floor of 5 crores and a cap of 20 crores. So irrespective of the company, this is for 100 crores, 100 crores valuation. After discount, it comes 80 for me. But since there was a cap, for me, the valuation is pegged at 20 crores. So at least I get 20 crores ka 5%. 5% of the company because 1 crore by 20 crores. So
discount is on the cap, right? Discount
no.
in your case
Discount
went
is
on cap.
No. Discount is on the future round of valuation.
But
with a
cap
capping.
was there.
Yeah, with a capping. That's why I said, suppose future round of valuation is 100 crores. My discount was 20%. So ideally, I would have got only 80 crores at 80 crore valuation. But in our case, it was capped at 20. So that 80 crore is to be ignored. Now cap comes into play. So I get shares worth at the valuation of 20 crores only. So that way I benefit straight away.
Discount is not again on cap.
No, not on cap.
Okay, cap is a cap. Okay.
Yes. Floor and cap is fixed. That is to be triggered
Cap
only
and
once you
floor-
have put a discount.
Cap and floor are boundaries, lower and higher boundaries.
Yes, correct. Yes. Yeah, Natasha, sir, you were asking how to show this in balance sheet, right? I think that was the question.
Yeah, that was my question.
So again, this is just a safe note, right? This is an agreement between two parties. Company law does not allow such. For that, still you have to go ahead and issue an instrument like a CCPS. Now in that CCPS, when we issue, there you can put a lot of conditions. Like for example, there can be a formula-based conversion ratio for CCPS. So what we do, you are going to issue CCPS at suppose today it's 1 equivalent to 1, but there's a formula attached, exactly this floor, cap, etc. We put that under the conversion formula itself in the future round of funding. That is what they put, and then accordingly it's shown as a CCPS only in the balance sheet.
So is it in other countries in US safe notes is allowed? So they don't have
I think
shares
so.
or something
Yes,
like that?
I think so.
Okay.
I'm not sure about that.
Oh, okay, makes sense. Thanks.
Actually, there is one VC, 100x VC. They have started this iSafe notes, and wherever 100x VC is there, for sure it has to be iSafe note.
So
and
they just copied it and made it iSafe, Indian safe.
Yeah, actually,
Y Combinator actually, I mean, Y Combinator, it's very much, they talk about it. I don't know who else invented this. Maybe I have heard from Y Combinator.
Yeah. So Y Combinator is a US-based incubator kind of sorts.
Correct.
Yeah.
Rahul, just a question on this part. So basically, when we issue this ICF as a CCPS, so basically our valuation depends on the next round of funding. So my general question is that how to encounter this 5627B angel tax? Because we are issuing the share right now. Okay, the valuation is not fixed. Okay, because it depends on the future round. Then where is the share premium taxation comes and how to basically justify that 5627B argument?
No, that's the point of a whole angel tax exemption, right? We have raised money, X money has been come in. Now, since the time it is following all the criteria, angel tax does not come into play. So we not do those exercises at all.
Why it is not applicable?
No, if you are availed an angel tax exemption, correct? So if you have already availed angel tax exemption, then you need not justify the valuation at all. No?
Okay. So it is applicable till 25 CR, but after 25 CR, when we are raising the shares through CCPS or ISAF, so at that point of time, how to encounter this 56 to 7B at the time of issuance of CCPS, at the time of conversion, because we don't know what would be the conversion price, the fair value of the CCPS, which we are going to be converted.
I'm not sure if I got your question right. So let us understand that first. See, what does 56 say? 56 says if you are raising any money more than your fair value, then you have to follow that rules and pay taxes. Right?
Absolutely.
That becomes what we are saying here, whether if we have a valuation report from a merchant bank valuer, etc., right? Then obviously the question of 56 does not come into play.
Correct.
Correct. So
Correct.
what is the instrument? How does it matter?
No, so for example, if we are issuing a ISAF note, okay, that you give me the money 100 rupees right now, we don't decide the valuation right now upfront. In future, the next round of funding, I will give you 20% discount, okay, whenever it might be. And this is a floor cap and the higher cap and the lower cap. Okay, so we are not getting onto the valuation at all, okay, right now. But we are issuing, so 5627B is applicable. Now, whether we are getting the money higher than our fair value or not, how to decide that?
So I think generally, I think you are a better person to answer that rather than me.
No, so basically, I had a question from a lot of experience, because I am also not getting the answer from quite a lot many people. So I used to ask the people who has the experience of this kind of fundraising.
So I can do one thing. I can check. So again, generally what happens, so when we do this whole SHA, SSA negotiation, there are lawyers involved, right? You need to get a lawyers involved, because those each and every clause has to be cleared. So I can check with certain senior partners of some really good law.
That would be really helpful.
Who are specifically in the VC and PE segment. I can check with them how are they dealing with it, because they keep on doing this day in, day out. So I can check that and get back to you.
That would be really helpful. Thank you.
Sure.
Mr. Rahul, I want to make a statement here. Okay. Whenever any company secretary is approached on this aspect, I want to clarify what the Companies Act has to say. Okay. So in case, imagine a scenario where you have not approached any valuer now. Okay. And you are approached a valuer in the next round, wherein everything, conversion is decided, say 20% discount. Companies Act is not permitting any, issue of shares under discount when compared to the valuer, fair value of the equity share. So in the market, what normally we suggest is go for a valuation just for the Companies Act purpose, not for any other, conversion terms. So there is a base price which is fixed. We are following everything under Companies Act. Valuation is obtained from an RV, but it is just on paper. This is the base price. Okay. So next round, whatever you are agreed, yes, that will happen, but that cannot go below this, floor, whatever registered valuer has set. This is what we suggest them. Because otherwise the Companies Act is not exempting, even if it is ISAF notes, any like 100 crores is the valuation. If you have agreed at 80 crores, that is an agreement, but that is not permitted under Companies Act. And one
but that brings more questions. So ma'am, I would
it's a Companies Act. I just thought I'll share with others. One more thing, what the market is doing, I don't know it's right or wrong. They go for a valuation at 80 CR in the next round, when actually the value is 100 CR. How they do it, I don't know. But then this is the practice. They go at 80 CR. Whoever has got ISAF notes, he'll get converted at 80 CR, because that way you're totally complying with Companies Act. And that balance 20 CR, it's up to the investor who is coming new, no? Or he is also taken into agreement that, he is supposed to get at 100 CR, but he's getting a valuation at 80 CR, and he is issued at more than fair value. More than fair value by RV is permitted. Okay. So these are two things. Just thought of sharing this with other participants. Go on, Mr. Rahul.
Sure. Yeah. So quickly, what I'll do, I'll again, in the paucity of time, I'll try to share the basic steps, right? What all we do during a fundraise. Initially, fundraising is a task. It's like sales, right? When we talk to 100 people, we just need one to say yes, and we are through. We can say we are arrived. But talking to those 100 is no joke. There's a team number of steps, activities that needs to be done. Starting, I've tried to put that in one single slide. Let's see whether it justifies or not. One, we need to create a business deck. We need to create a business model. We call it financial projections as well. Now, what is financial projections? It's not like a typical traditional financial projection that we used to make for bankers, where, okay, we pick up a P&L, increase revenue by 10%, increase this cost by 5%, and we so see the company would grow, and the bankers would happily take it because ultimately it's backed by collateral. That does not work in case of a startup. It has to be a very detailed model. Each and every line item of the P&L has to be worked out, be it revenue, be it expenses, everything. So if I'll give an example, suppose I say I am going to make a revenue of say 10 crores in the following year. That 10 crores have to be backed up by unit economics. Like for example, what is the unit that I'm going to sell? What is the price per product or service that I'm trying to sell, right? What is the justification of those prices that you have assumptions? The revenue assumptions has to be questioned and clearly told. Secondly, the number of users that you're saying, okay, you will get X number of products that will be sold, which will be sold to how many users? Now, whether they would be a repeat user, each user that you are going to, you are saying, okay, this will, how will that come? What is the spend that you are going to do, that we saw that the customer acquisition cost? What is the amount that you're going to spend and they get that users on board? So all of these has to be put in Excel, a long detailed one with revenue assumptions, with cost assumptions, with other assumptions, etc., etc. And then that will tell you, okay, what is the amount of money that you need, that you want to raise, and plus, where will this money take you further? Once you have raised this X money, where does this take you for your company from X to whatever that level you know? So that business model has to be created. Deck has to be created with a clear-cut flow, where if we define a problem, we define the market size, what is our target, what is the solution that we are bringing, what is our USP, what is the competitor landscape, what is the ecosystem, about the team, and if any significant achievements or tractions that we already had. So all of these has to be put together. The model, more on the financial perspective, should, and the storyline in terms of the deck perspective, have to go hand in hand. Once we have done all of these, then there are multiple business metrics and that we see, that we try to show them. Like for example, there's something called sales funnel. I'll give an example. Now sales funnel starts from leads. It could be cold leads, converting those cold leads into warm leads, from that warm leads to hot leads, finally hot leads to conversion. So that complete flow, suppose there's a company which is there into business in last 2 years, we create a complete data, which we call as data book. Now we create a complete data of the past month-on-month basis, or depending on the type nature of business, or how have been we converting. So from that lead to final conversion, suppose my conversion ratio comes to 2%. Now that 2%, would that improve? Why? What happened in the past, and what is the next plan for the company? So all of these has to be prepared. Now you see this term called IM, information memorandum. This is another jargon for business deck or a pitch deck. We large companies or the large VCs, they call it IM instead of pitch deck. That's it, just a different term. So all of these has to be done. Then you do a multiple meetings. There are multiple back and forth questions, back and forth happens, and finally, if they agree and they like it, then the investor would issue a term sheet. Now you can also involve investment bankers. So investment bankers' job is to do all of these stuff along with the founder, and then create proper data book. This is where a lot of professionals, even now, a lot of finance professionals, and generally I've seen IBs are mostly MBAs. Not a lot of CA or CWS or CS have been involved into becoming an IBs. There are two things that are required. One, understanding of business very well. Second, having that right connect with a lot of VCs and PEs. And third, you have to be a storyteller, period. That is the most important thing. If you cannot sell a story, making it very lucrative, showing a very large picture in the future, then it's very difficult. So which is what it takes. But now I see of late a lot of finance professionals like CAs, CWAs, CS, etc. have started investment banking services as well. And these are all success fee based businesses, and really good money that you can make if you can actually crack that. Once the term sheet is, we get the term sheet. In the term sheet, obviously the valuation, funding, the macro terms are defined, and then the DD happens. DD are various types: financial DD, legal DD, tax DD, commercial DD. Commercial DD is something basically they just do at their own end. They see, okay, whether the business is viable or not. But financial DD is off the books. Legal DD, in legal DD, legal share ownership is the most important critical factor. That is something like a deal breaker. If there's any challenges in terms of share ownership, any past disputes with the founders, among the founders, etc., then that is something that they puts them off. I have seen a lot of term sheet being taken back by investors in cases where the legal ownership was not very clear, or there were some disputes or some documentation issue. So from that perspective, I think specifically company secretaries play a very, very important role here, specifically in these. Other basic compliances, GST not filed, income tax not filed, this not done, they are all okay with that. These are not taken very seriously because they know, okay, these are challenges. Small companies don't do compliance very well. But if there's any challenge in terms of company law, specifically share ownership, because that is something that they defines their rights. They're absolutely, it's like a non-negotiable item. So that is the most important one. Then finally, when the DD is done, if they like everything, funding happens. When the funding happens, we enter into a lot of agreements. It's called the SHA, SSA, and other agreements. For that, there's a lot of negotiation that needs to be done. A lot of negotiation that needs to be done. Right. So I'll just quickly tell you what are these agreements called. Right. This is the most important one. It's called definitive agreement. Definitive. Why definitive? Because it's defined in a way. So one is called SSA. Other one is called SHA, and third one is a DOA. DOA is not that critical. It's called deed of adherence. I'll not talk about that. But SSA and SHA is the most important document that we do. Again, here a lot of company secretary lawyers play a role, and there are a team number of clauses that needs to be negotiated with the investors. And so this either it would be done by the founder themselves, or it could be done by the CFO, internal finance person, finance head. It could be done by a investment banking professional. Now, what is the SSA? Share subscription agreement is an agreement which is signed by the new investors that are coming on board and the company. So the company and they. So what are the critical points in this? One is called CP and CS. CP is conditions precedent. So there are certain conditions before the investments which becomes part of this agreement. Okay, you need to follow this. Only then I'm going to put money. Once the money has come, there will be certain conditions subsequent, based on which you need to follow all the clauses, whatever has been written there. There are a lot of reps and warranties, typical standard. Okay, founders are giving these are the market representative, we are representing, we are giving so much of warranty, we are saying, okay, this has done, that has not been done. Now, based on reps and warranties, there's a disclosure letter which says, okay, like for example, I give a representation as a founder that I have filed all the GST returns on time. In a disclosure letter, I say, okay, this particular month, I have not passed. I have not filed the GST return, but I am disclosing it myself. So which is considered to be very healthy. Okay, you are being upfront and telling, okay, this is something that has not been done. Okay, then there's a cap table, which is part of the SSA. SHA is a shareholders agreement among all the shareholders, which includes your existing shareholders as well as the new shareholders, founders, and the company. So these are the parties to the agreement, in which now this is something that is very, very critical in terms of negotiation. There are too many rights that the investor would ask for. And as a founder or as a person who is advising a particular founder, we need to give them the right advice, help them to negotiate this. Like, for example, an investor may say, okay, I'm putting X amount, I need a board seat. I want to become a director in the company. Now, whether to give that board seat or not is a negotiable item, right? And there are certain practical thumb rules how the market operates, which we know. But this is something very important. Then what are the voting rights? What are the DVRs, like fractional voting rights? ROFO, I'm sure a lot of you must be knowing right of first offer, right of first refusal, anti-dilution rights. Suppose if I spoke about down round, right? In case of down round, this is the biggest risk. The anti-dilution comes into play, where the existing investors get more shares free of cost, just to ensure their ownership in the company. The tag along rights. At times, what these large investors, what they would do, they would take a tag along right. They would say, if tomorrow I get a buyer, if I am selling my shares, I can force you, sorry, that is drag along. I can force you to drag along with me. I will drag you to that transaction, and you all have to sell your shares as well. At times, founders or maybe small shareholder angel investors would say, okay, I want a tag along right. Like, for example, tomorrow, if a big guy is trying to sell his 90% stake, I also want to, I have a right to be tag along to in that transaction itself. So again, then there are transfer restrictions. Like, for example, a promoter may be asked to stay with the equity. You cannot exit the company for next 4 years. So we call it reverse vesting. So a promoter is already holding shares, right, in the company. Now, in that perspective, there could be a condition where it says, okay, you are already holding shares, but there is a reverse vesting clause that we put under SHA, where your existing shareholding is not with you. It will get vested in next 4 years, 25% each. So after 2 years, if the promoter says, okay, bye-bye, Tata, bye-bye, I've enjoyed the money, I'm going out, you cannot do so. And then your 50% of the shares are gone. So, of course, technically, legally, what we do is that in case of reverse vesting, if that has to be done, either they have to transfer their shares secondly to the investors if they're moving out, or there has to be a buyback process as per company law. So again, as I said, laws are not so easy to be followed, but practically there are a lot of agreements that can happen between parties. But then we we have found ways and means of following the law as well, but ensuring, okay, what is required to be done, that needs to be done.
Yeah, in fact, Rahul, one thing here, so transfer restrictions, just for the benefit of participants, usually 5 to 10% is permitted of whatever the promoter holds. Generally investors agree to that. Only 5 to 10% of his holding. Okay. And one more thing, when you're talking about reverse vesting, I don't think many of us are practically doing that as such. But what is your experience? Is it very common or is it rare?
Yeah, absolutely common. Every SHA from a VC or a PE will have this clause, because they are putting a lot of money based on that promoters and the
That one
founders, right?
person. Actually, they bet on the person
Yes,
more
exactly.
on anything else.
Correct. And if you see technically, right, tomorrow, suppose I raise my company's actual worth is 10 crores in my view, but they are putting money at 100 crores because I was able to sell a very good story, right? If someone is putting, say, 100 crores in my company, or maybe 50 crores at 100 crore valuation, which means they are only holding 50% of my company. I still hold 50%. Tomorrow, after 1 year, I just blow up all that money and I say, or if even if I don't blow up, I'll say I'll just close down the company. And if that company closes, what happens to the money? The money will be divided based on your equity shareholding. So automatically that guy can just take so I had valued my company at only 10 crore worth, but today I am holding that 50% shares in a company at 100 crore valuation. So I become worth 50 crores. If I am holding all the shares of that 50% or today, I can just say, just let's close down the company. I'm not going doing anything. So I get that 50 crores free of cost.
And
I did not do anything.
There is one more thing. It's a friendly exit and a hostile exit. Actually, friendly exit again has a favorable exit terms. Like you are agreeing on something, it is beyond humanly possible, right? Something even investors agree, okay, this person is not able to deliver. So again, that friendly exit has a very beneficial terms of exit. Hostile exit, like in what cases you have said, it's very, I don't say atrocious, but yes, all the promoters are to be, aware of this. They
No,
should.
absolutely. That's what I'm saying. These are all negotiation points. I'm not trying to say, okay, this is the norm. There could be multiple different scenarios and multiple, and even again, ultimately, it's an agreement between parties, right? This can change also. I have seen a lot of startups where they get the agreement changed in favor of one and not so favor of others. So this happens all the time.
Rahul, one question. Can you just elaborate the anti-dilution clause and how does it practically work?
Sure. So anti-dilution means basically, suppose a company has done a round at a 20 crore valuation and they have issued shares, and there's an anti-dilution clause, which is the right to the investor that, okay, if any future further issue of shares will happen at this valuation or above this valuation. So basically the price per share would be higher than this. If that does not happen, it's a down round. And if the company goes and says, okay, now I'm issuing more shares at a 15 crore valuation, that means the earlier investor who has put money at a 20 crore valuation have actually got less number of shares. But the new guy who is coming in, now he will get more number of shares at a lower valuation, which is where the difference of these 5 crores, so the company has to issue free shares to these guys, free of cost, without any money, at for that 5 crore ka difference, whatever the differential number of shares that would come in their kitty, so that the ultimate shareholding, suppose I had put 2 crores in a company at a 20 crore valuation, I was holding 10% of the shares. Now the company is raising more money, but at a 15 crore valuation, I still want to continue to hold 10% of the share. For that 10% to be true, more number of additional free shares has to be given to me. So that shares are given to the company.
But is this practically also seen, because this has quite a lot of challenges from Companies Act as well as income tax as well. Then how is it practically
that's
possible?
true.
Yeah,
See,
the
that's
Companies
true, but
Act perspective.
Because Companies Act, you cannot issue the shares free, and the income tax, whatever you are receiving as free, that will be that will be considered as your income. You have to offer it to tax.
Correct.
Actually, I agree. Sir, I agree with your point.
Free,
what you're talking about a business, Companies Act income tax doesn't permit, but they have to find out ways and means between promoters and the owners. It's not permitted.
Absolutely. So I'll
Or
tell you, when I
maybe
say free, right?
I'm envisaging a situation whether promoter will be penalized and the promoter will actually give it as a transfer. Does that happen?
So I would say all of you are right. There are ways and means that people do, right? Depending on the situation and depending on the captable situation. When I say free, it could not be free. It could be a nominal value. It could, again, money could be routed in some other way. That is also doable for complying the law. And at times there could be secondary transfer that promoter is giving their shares to them to ensure that. And that secondary can happen. But again, the question is right. Even if it's a secondary, right? If the company has pegged a valuation, still that valuation challenge still comes. There are questions that needs to be answered. So it's not so simple. Or there could be another way where you just create a just like we create a ESOP pool, you create a dummy pool for that. That pool is again not legally issued, but technically in the SH it is agreed that okay, my fully diluted cap table will show my additional ownership. But legally, I would still be holding less number of shares. If that taxation becomes a very, very big challenge today, and when that exit happens at later point of time, that time this gets adjusted automatically. Or when a new investor coming in at a higher valuation, that time this gets. So again, these are something that again, they know a standard answer to this. So depending on the situation, we have to find answers to how to solve it.
Mr. Rahul, I feel that, it's just a matter of time because all these things are happening recently. Now people are just waiting and watching. Yes, this company will grow. But then as times change, we could see all of this becoming more of a reality rather than, right now it's more of our academic discussions, right? We'll have more case studies to see in course of time.
No, Selpa. So that's what I'm saying. It's a reality. It's happening across. It's not something new. Only this down generally does not happen very frequently, but it has happened a lot of. At least I have seen 10 cases already.
In COVID time, it happened, Rahul. COVID time, many
yeah.
of our clients struggled because of this anti-dilution. They could
Correct.
not get new money and they had this penal clause and they really struggled to raise the money.
See, again, if you ask me, right, I have been on both sides, right? I've seen the pure typical compliance mindset that we all have, right? And I have also been there, right? And plus I have seen now I'm a founder, right? So I have seen both sides, and plus I've worked for a company where I've helped them raise money. I've seen the investors, sat on board meetings of certain companies. Now, no one gives a damn about compliance, to be very frank. They only care about this is what I want. It's our job to figure it out. How do we do it? And then we are smart enough to find ways and means of doing it. I'm not talking about doing something illegal, but the idea is to finding the right ways. Okay, because ultimately, even I strongly feel that something that needs to be done has to be commercially viable, right? It should be business sense, if it is making business sense, then should be done. It should be allowed. Till the time, of course, I'm talking about something illegal. We are not talking anything illegal here. It's a term or a clause that we do. Now, if a law restricts ourselves to do something that we want to do, then that law has to ideally should be changed. Now, what are the other repercussions, other challenges that may come in? That is something that obviously lawmakers need to think of. But then business cannot stop, right? Just because of a particular law. And laws do change because of these new innovative things that come up in the market.
And one small announcement, I hope the participants are okay if this session extends for 15-20 minutes because we ourselves have taken so much time of Rahul asking questions.
Shilpa, I think we'll wait for some more time.
Yeah, we'll continue for some more time. We don't want to stop. We are eager to hear you, Rahul, more. Please go on.
Sure. One very
And
important concept.
I recommend one more session also. It's so interesting and gripping. We need to have.
Yeah, actually, the problem, Mr. Rahul, is the traditional mindset, what we have, and the new age things. We have so many doubts, but then we don't know whom to address that to.
This is the right platform. Yes, sir.
Yeah, I would say, fortunately, unfortunately, I am sitting in that mid path, both sides. I understand from where those questions are coming in, and I have seen the other side as well. Cool. So I'll just continue. So now, in the interest of time, right? I have just few slides left. Let me just finish that off quickly, and then let's do a discussion face to face, right? So this is the most important concept that every investor and every founder is interested in, and they need to understand very clearly. So I'll just quickly tell you, go through this P&L and tell me what do you think, that is this a good business or a bad business?
Bad business.
Bad business.
Good business, sir.
Good business. Okay.
Contribution margin 50%.
Okay. See, we already have two contradicting views, right? And that is the beauty of business, that everyone will see our same company or the same business in a very different form. So let me show you something very interesting. Now today, if you see, right, this is what is unit economics. Basically, when we try to convert a P&L into per unit basis, we call it unit economics, per unit basis. So what I'm saying, suppose my product, this company is selling a product, per product price is 100 rupees, and my variable cost to service that product or maybe to provide that product is 50. So I make a contribution margin of 50%. This is not typically how we see P&L in a audited financial side. We don't break that up into variable cost, fixed cost, etc. Right? Then suppose there is a customer acquisition cost, that's marketing cost, which is 60 rupees, which means I have to spend 60 rupees to get one customer who is buying a product for 100 rupees, and I'm making 50 rupees out of it. So I'm losing 10 rupees per customer that I'm getting. So apparently it looks like it's a very bad business, right? And then there's a fixed cost. Say let's assume this is absolute value, say 80 lakh rupees that I have to spend. Now, if I tell you, apparently it looks, boss, this company will never make money because how much ever units you sell, and if you multiply by -10, which is what my contribution margin 2, I will always have a negative number, which means I cannot recover this 80 lakhs ever. So this business is a super bad business to be in. But if I change a bit, if I change the perspective a little bit and I say, okay, I spent 60 rupees to get a customer, but typically I've seen a particular customer who comes on my platform at least buys 2 products from me. We call it retention. We call it repeat user. We call it, if you remember the term LTV that I told you, lifetime value. So in my case, in my example, that customer, any customer who comes on board, at least takes 2 months subscription or at least buys products twice in his lifetime before he drops off, before I need to re-spend the marketing cost on getting that customer again. So the whole unit economics would change suddenly then. This 100 becomes 200. My contribution becomes 100. So I make 100 rupees from that one customer and I spend only 60 rupees, that is once. So I make a profit of 40 rupees per customer. Suddenly this business becomes so lucrative, and I start thinking, okay, now how many units do I need to sell to recover 80 lakhs? And then once I have reached that number of units, after that, if I scale further, I'm going to make a lot of money in this business. This is the exact game that all the VCs are playing. This is the exact game. They are not interested in your fixed cost. We see that, okay, these people are burning money, right? Where are they burning money? If you observe carefully their P&L in this format, you would observe carefully is that most of these companies would say, okay, I'm CM positive, contribution margin positive, which means at scale, tomorrow when my number of units sold would be really, really large, this fixed cost will not grow in a proportion because this is not a variable cost. These are mostly like salaries, corporate costs, etc., etc. So today they are ready to burn. They are ready to give a lot of salary to people, etc., etc. So which is where the whole scenario changes. And this is what investors are looking for. Are you CM positive? Explain me your unit economics. I don't know if you guys are following Shark Tank India right now. Almost every startup is being asked to, can you explain your revenue from 100 rupees that you are making to ultimately what is the profit that you are making? That's the idea. And this is what the investors are looking for. There's a technical term called LTV by CAC. It's a ratio basically. In my case, LTV is what? 200 in my example, second example, and my CAC is 60. So 200 by 60. That ratio is very, very important. In this case, now, what I'll do, I wanted to show this from a very different perspective as a finance professional, right? How we can actually see this from a very different angle. Say, for example, my revenue is 100. I know I am making, before my CAC, I am making 50 rupees. So my revenue by CM1 is 2, 100 by 50. What if I have to, if I am a CFO of a company, I have to give a target to my sales guy saying that, boss, how much you can spend in your customer acquisition cost. And he does not know the complete P&L. I don't disclose that to him, right? I'll tell him till that time you are able to. So what is your revenue by CM1 now? Let's see that. It's right now 100 by 60, which is less than 2. That is the reason I'm losing money. It's 1.7, which is where I'm losing money here. So what I mean to say, if I have to give him a target, I'll say, okay, what is the amount you want to spend? He says, okay, I want to spend 60 rupees. I would say, okay, if that is the case, then you have to sell the product at 120. If you're selling at 120, because that ratio is 60 into 120, then I know 50%, I'll make 60. At least I'm break even at that point of time. Now the sales head will come back and tell me, boss, I don't control the pricing. It's market driven. I can only sell it for 100. Then I will tell him, boss, if that is the case, let's agree that if you cannot sell it more than 100, then you cannot spend more than 100 by 2, the same ratio I'm using. You cannot spend more than 50 rupees in our case. If this equation has been sorted out properly, then you can become contribution margin positive at any point of time, which is where, of course, you will not tell the truth, right? You will not say 2. If it's 2, you will say, okay, it has to be at least 3x of your spend. So if you want to spend 50 rupees, you have to sell for 150. Or if your revenue is 100, your CAC cannot be more than 33 rupees. Very simple. Because he may not know the true equation, what is held here. So this is something for your internal calculation first, and then creating a clear-cut target for the sales here. Because I'm telling you, in any company, this is very critical. Now, of course, then, so one companies burn a lot of cash here in the CAC, and then they burn a lot of cash in the salaries, specifically for the in-house people. And then again, practically, companies do a lot of juggling in the numbers as well. Like, for example, I'm burning a lot of money in marketing, but then I divide that into 2 parts. One is called brand marketing, one is called push marketing. Push means basically digital marketing, etc. So I would show only the sales marketing portion in CAC, and the brand marketing I show under fixed cost. But are the investors stupid? No, they're not. But as I mentioned, even they have a mandate, they have to invest. The whole cycle keeps on going, and it continues. Any questions on unit economics? Very basic explanation, but yeah, I thought this would be interesting for everyone to.
Do you think a valuer has to capture this in his valuation reports, the present scenario or the future scenario?
No, not allowed. Not required.
For our understanding.
Yes. This is just for knowledge, because this is something that what every investor and every startup is looking for. Even internally, when I advise a startup, or even for my own startup, we always track the monthly MIS based on these metrics. We share these data to the investors, etc. So we do that all the time.
So basically, understanding the fixed and variable part is very critical here.
Absolutely.
Right?
Absolutely.
What is fixed and what is variable, and ensuring that they've been reported correctly in these calculations.
Correct.
So from where can things go wrong is basically if either the categorization, what is been classified as variable cost above CM1, and what is CAC, for example, right? That categorization is important. The fixed and variable components is very critical here. That's a real thing to be understood.
Yes, absolutely right. And that's a very critical point. In fact, companies do play around on that. And this is a very important. So when we say DD, right, financial due diligence, financial DD is not audit. In audit, we do vouching, we do verification. In financial DD, they don't do that.
Yeah.
They very simply, what they do is that they see these kind of things, whether your classification of variable cost, fixed cost is right or not, the way you are presenting your data is true or not. So these things that these guys do.
Yeah, and I don't know, maybe I'm veering a little off the topic, but Nataraj and Nanjin, all the cost accountants who are familiar with in the 20 years ago, 15 years ago, who had read this activity-based costing and all that stuff, right? I feel that the applicability of all of that lies here. So repurposing and refurbishing activity-based costing to unit economics is a relevant topic here, correct?
Correct.
Yes. Actually, Subbaraidu sir, I was about to say, this is nothing but a management accounting principle presented in a unit economics manner.
And also identify cost drivers, which is the crux of activity-based costing.
Yeah, the key factor being contribution margin.
Exactly.
There are 2 key factors here, margin 1 and margin 2. So this is where variable cost, whether it includes CAC or not, so that bringing it to unit level will be a challenging task. So that is one thing. But the other thing which I see the drastic thing happening is the founder is required to understand unit economics to pitch actually. So that is a very challenging thing for the founder, and otherwise they will not be able to present their pitch if there is some intelligent investor. Am I right, Rahul sir?
100%, sir. 200%.
So Nataraja and Nanjin sir, maybe you and me can collaborate on a future topic on repurposing ABC for unit economics for the startup world.
Yes. No, I actually am studying this, but not yet through.
It's an interesting area. It's a very, very interesting area. And
very interesting. So I want to apply management accounting here and try to see how this works.
Rahul.
Yes, sir. Yeah.
The only element which is different from a traditional, what Mr. Natarajan said about unit economics and the current startup world unit economics is Yeah, the unit economics is supposed to be constant and therefore it will be able to cover fixed cost with a scale. Whereas the unit economics in a startup world actually is no longer fixed. The cost keeps on changing for the same production of the same unit as things progress, is in my view, because what competition, what margins does one get in the initial period, it does not sustain. And therefore, all these projections go for a toss and eventually startups do have that liquidity crisis.
Ganesh sir, see
that's a very good point. So I would say
Yeah.
that how do we capture that? That is captured in the projection. That is the reason we don't create projection on an annual basis. We create on a monthly basis. So what we do, even in the unit economics, when we create projections, we show what is the current unit economics and how the economies of scale would play in. And again, it's based on up to number of assumptions, obviously. And then how that margin improvement would come into play as we move forward. So that is
See,
again
precise,
captured in
yeah.
the projections itself.
See, the heart of, I don't know, I had spent a donkey's years in researching activity-based costing and all this thing. So really identifying the cost drivers, right? What makes cost, total cost or per unit cost go up and down? And understand causality, as they say, understanding causality, right? That's at the heart of all of this. So unit economics and ABC or time-driven ABC something. At the end of the day, what you're talking about identifying causality and understanding that causality.
True, true.
Rahul, are there any benchmarks to be followed? Do investors look out for any particular ratios?
Yeah, they do.
Economics?
They do, but again, it differs from business to business, model to model. Like for example, as I mentioned, right, LTV by CAC is a very interesting ratio that they look for specifically I would say a SaaS kind of model, right? Software as a subscription, where it's or a subscription kind of model, where again LTV by CAC, I did not say that complete thing. So for example, when we say this, right, there's one more metric that they see on a month-on basis. What we create is that what are the new users you're adding, what are the churn or the dropouts that you say of the users, and what is the closing. So depending on that ratio, month on month, it keeps on moving, and then we keep on changing this economics and how does it pan out and what is the history. Because even your dropouts are equally important to understand your LTV by CAC ratio, because that would keep on changing. So each industry, there's a different, again, from the practical aspect. But again, let me give you a very interesting insight, right? Without naming a company, I was sitting with a very large VC, very popular VC. In the board meeting, when we were sitting and presenting the data, this guy was trying to see that same business, which is an annualized business, in a monthly unit economics basis, which I clearly told him, sir, it does not work that way. You have to understand the business, because though you're asking the right question, but in the wrong industry itself. There could be businesses which does not work on say, for example, I offer a service which is only annual, right? It's only annual. Then you cannot break down into, okay, I take a subscription on a particular month, but I do not get any revenue for next 6 months. That is actually okay. Then you have to break down that business on an annual basis only. You cannot do that on a monthly basis. So understanding the business very deeper, and then, as all of you rightly mentioned, that classifying the cost into variable cost and fixed cost. And again, when we say fixed cost, right, it's not simple fixed cost. Theoretically, it's fixed cost, but there are a lot of stepped costs as well. Like for example, there may be an element of fixed and variable both in a particular cost.
Absolutely.
Or there could be a step up cost where, okay, up to this many units, I know it's fixed, after it increases. So that variability has also to be incorporated. Now, all of these, that's why I said financial projection itself is a task. But doing in Excel is not a task. Excel, we all are champs of Excel. We have spent our lives in Excel. But the point is, first understanding the business and then creating a model is something that is most important. If someone has a good understanding of the business, financial model creation is very easy. Even financial projections, there's no fixed format per se. If I have done that, I've struggled with that. I'll tell you, initially, when I started my journey with Startup World, I tried to create models based on existing. I took some models from my friends, etc., and started trying to create a model similar to that for a different business that I was trying to advise. And you won't believe, it was a nightmare for me. Then someone gave me the right advice, this is not the right way to do it. You have to start in a very clean slate, in a clean Excel sheet, where you first understand the business and start creating those small nuggets, and then finally you have to concentrate all of them. And that is where I learned. And now you won't believe, even if I know a business very well, even if I get an existing model, I don't start with that. I first start with my own fresh screen and then only move forward towards the projections.
Actually, you are right, Rahul. Getting up to that stage.
One question, can you permit?
Sir,
Just one
Mr.
comment I
Senthil, 1
wanted
minute. Mr. Senthil, 1 minute. Just one announcement. What I suggest, Mr. Rahul, okay, please take all the questions now. And I request you, let's have a sequel to this Rahul session too.
Yes,
So because,
correct.
I understand you want to share, actually, that's our purpose, but then all the participants want their questions to be cleared. So I request you to have a follow-on session. I will get back to you on this on your convenient time. But my request is take all the questions now on, and PPT for now, please, we'll have it in Rahul series too. I hope it's fine.
Yeah, absolutely fine.
Yeah. Please go ahead. Each one of you, please raise your queries.
Yep.
Sir, I have a
Rahul, I have
question.
one query.
Yeah, can I go ahead? So in case of CCPS, is there any logic for fixing the ratio, or is it negotiated? Conversion
Negotiated.
ratio.
Absolutely negotiated. So generally, see, typically CCP is just an instrument, right? If I issue equity or I issue CCP, this should not matter. So generally, practically, what is one share, one vote, and one share, one ownership. Simple. So CCPS is as good as equity only with certain extra rights or liquidation preference that I mentioned, right? That is the only difference. But sometimes, just to play around with this valuation, etc., they do say, okay, I'll take a CCPS with a conversion ratio which is higher than 1. But again, practically, I have not seen much of that happening, except in cases of these safe notes that we spoke about, where the valuation is not. So we call it whether it's a pricing round or not. So sometimes we say, okay, it's not a price round because we are not able to price the company. We are not able to find the valuation. In those cases, this complexity comes in. Otherwise, generally, it's one CCPS is equal to one this equity. When we create a fully diluted cap table, it's just that in two different columns, we put in one column equity, in one column CCPS, whatever series A, B, C, whatever, and then just add it up and so, okay, this is the fully diluted cap table. That's it.
Thank you, sir.
One question, Rahul. When we do pitch deck, there is a concept of TAM, SAM, and ZOOM. How do you typically arrive at it in terms of if it's I know it's a little this thing, but can you give you kind of a broad basis? How do we arrive at the TAM, SAM, and ZOOM?
Sure. So one first for the benefit of all audience, let me tell you what is TAM, SAM. So that would be helpful. So TAM is basically total addressable market. Basically, what our investor wants to see. They want to see the business that you are into does it have a really large market or not? So total addressable market. Then SAM is, I think, what is SAM? I forgot the full form.
It's an accessible market, I think,
What is
and
S?
then
I
obtainable
forgot S.
market.
Correct. Whatever. So the concept is TAM is the overall market. I'll give you an example of my company. We are into agriculture. When I say TAM, I deal into fruits and vegetables. I see India produces around $132 billion worth of fruits and vegetables every year. So that's my TAM. See, this is what overall production that we do in India overall, right? That's either if I convert, it's around 9 lakh crores, of which I further break down. Okay, out of that fruits and vegetables, since I deal only in fruit contributes to around 60% of that, hypothetically, right? Out of that, then further, I don't do all the fruits. I do much lesser number of fruits, say for example, 5 SKUs or maybe 1 SKU. That has a $14 billion market, which is approximately this many thousand crores. So this is how we break down. It's like a sales funnel again. Overall market size is X. In that further small obtainable market is X. And in that, this is what the target market that I am doing. In that target market, what I'm trying to achieve is that I need, say, I want to achieve 1% of that market or 10% of that market. Based on that, we create, okay, this company today is X and tomorrow it can become such a large company where we have a good market share and we create a lot of value for the investors. That is the reason every investor is interested in knowing what is the size of the market. We call it market sizing. So, and where to get this information? There are n number of reports available online, paid and unpaid both. If you put some effort, you get free reports as well, where every industry is being researched on. Like for example, agriculture or whatever you see, right? All these industries are being researched on. They tell you, okay, this is the market size. Now there are various different means of justifying or finding. You see multiple reports, try to find the best way, because every researcher will have their own style of researching. So it may not be true. So at a high level, they see, okay, this is X billion dollar market globally. This is the Y billion dollar market in India. So accordingly, that way we use a lot of research reports. In my case, specifically, I can tell more in detail because I've done that exercise myself. Like I was a CFO for Vedantu. So Vedantu made a tech company. So in that time when I was involved, EdTech was not that big in India. Today, Baiju and Academy, Vedantu all have become too big, but that time it was not that great, right? It's a small market. So we took up a lot of international companies to see the benchmarking, what is their market size. Like, for example, one of our Chinese investors selected $20 billion conglomerate in China, was one of the investors in the company that time. So we took their market size, what they are doing, it's a similar model. So that is how we created the whole thing. Then in India, we saw, okay, since Vedantu was into educating, specifically test prep for these IIT, JEE, NEET, etc. for 11, 12. We see every year 10 lakh students sit for these professional technical exams, and in which seats are only limited. So that 10 lakh into what is the tuition fee they are paying to across these different places, like Akash Institute, or maybe this other different offline institutes that were there in the play. That time online was not so prevalent. So we actually created ourselves, okay, if this many students are doing for 2 years, 11 and 12, if they do the tuition, if they are paying 1 lakh each, so that 10 lakh into 2 into 1 lakh would be the market potential that we have. We can easily target. Now, but if I talk about overall education, education starts from very basic, from nursery, class 2 goes up to postgrad. So that my TAM would be really, really large. But in that, my SAM or SOM would be little, and then further SOM will be further little of 11th and 12th market, which is our major product that we are trying to sell. In that, we intend to at least capture 5% of the market. That is how it's being done. In my agriculture right now, as I mentioned, of course, there are multiple reports who tells you, okay, this many $1 billion is the market value. But again, then how do I validate that? By doing this kind of exercise. Okay, I know this production data is available from the government itself. Okay, themselves. Is that, okay, so many SKU level, these are the products that we produce every year. Again, can we rely on those? Maybe not, but that's okay. At a high level, there may be a margin of error of 10 to 20%, but no one cares. They want to see, okay, as an idea, whether it's a large enough market or not.
One more question. Typically, when you go for a fundraise, from the time you start your pitch deck to building your financial model, what is the time, to call it in a very colloquial term, what is your runway like from you start to actually finalize the model and firm it up?
Again, no standard answer, Maithili. So depends on business complexity, right? I have done creating projections in a week's time, and sometimes it has taken 2 months as well, just creating projections itself. The first and the foremost step is creating that whole story, understanding the team, understanding the people, understanding the market. But that, and again, there's one exercise called as benchmarking. Before going to a VC, specifically, right? You have to do a benchmarking exercise. Now, what is that benchmarking? What we do is that we pick up similar companies in the space who have already raised money at what valuation. So when we say multiple, right? So the multiples are of various multiples. Like, for example, it could be a revenue multiple. Generally, EBITDA multiple or EPS, etc. in the listed space that we see, it does not work out because most of these are loss making. So it could be a revenue multiple, or it could be a GMV multiple. So there's a term called GMV, gross merchandise value. So which means, like, for example, a marketplace like Flipkart or Amazon, the value of transactions that is being transacted through them, they're not making that money. That's not the revenue, but it's called GMV. So what is the GMV? Okay, 10,000 crores worth of GMV I'm doing. So basically, this much worth of transactions are happening in my platform. But in that, my commission is say only 1%, 2%, whatever. That is my revenue. But it's GMV multiple also we have seen in the past in the marketplace. And now it's kind of depleting. Now, like Mr. Nataraj said, okay, our VC told him that, okay, now we are looking for profitability. That's true, because now suddenly this funding winter, etc., we keep on heading across. Now these people are saying, okay, now we want to show us the profitability. If not the profitability, at least show us the path towards profitability. When you will become profitable, tell us that, show us in the model. So all of these needs to be taken care of. So again, to answer your question, again, it can be done in less than a week as well, but I've done at times more than 2 months as well.
Thanks. Thank you so much, Rahul.
So initially, I would say creating model and projection is something which is in our control, but subject to the founder has to be very open towards opening up and discussing it. Because at times what happens, founders don't open up. If they don't, then it's a big challenge, right? If they don't open up, then you'll not get to know the whole story. And if you start building your model without knowing the whole story, then you are in a big mess, because redoing the whole thing is a very big challenge and very time consuming and expensive affair. Now, this part is still easy, I would say, projections, deck, etc., right? Story right, ensuring that story is right. Post that, doing the sales job is very tough. Going to so many investors, convincing them that, yeah, this is the right business and raise money. Getting that term sheet is very, very tough. It takes a lot of time. Sometimes if you are very lucky, very unique business model, it may happen very fast. Otherwise, it takes a lot of time. Post term sheet as well, getting money in your bank is not so simple. Post term sheet, DD, you have to be prepared for your DD. So when I say projections, right, you cannot stop at doing just projections. You have to ensure that your background work in terms of financial DD, legal DD is all ready, prepared. So knowing, having that knowledge, okay, what is required in a DD is very helpful. Once that DD happens, then the SHA negotiation, SSA negotiation starts. That takes a lot of time. There's back and forth. Once the SHA, SSA negotiation happens, post which the wiring of money happens. And all along all these, the company secretary role, lawyer, of course, for SHA, SSA, post which the CS roles comes into play, where all the CP and the CS that I told, condition precedent, condition subsequent, has to be done mostly by the CP, by the company secretaries, because most of the CPs and CAs are around company law filing, because they want to ensure, okay, all the filing has been done properly, proper notice of money raising, etc. all has been done.
Rahul, one question. So can you just provide some sources where we can get the details of the startup raising the funds and what kind of valuation they have raised the fund for our purpose of using the CCM method for the plans?
Sorry, what is CCM?
The comparable company multiple method.
Okay, so this is not available. One way is that you have to read multiple articles of the same industry whom you are helping, right? It could be your story, it could be a lot of tech circle, etc. Right? So many portals. Keep on reading, and try to. But the problem is that valuation is never disclosed. Most, unless it's a billion-dollar company, it's a unicorn, etc. So that is not a publicly available data. Very, very closed loops. Other way is that go to MCA, download all those companies that you identify, download their balance sheets, see if they have issued CCPS, and try to do a reverse engineering and work out the valuation for them. Third is you have to pay a lot of good money. There's a platform called Traction. Similar platforms are there who will give you this data readily available, but I don't think they give their platform less than 1.5 lakh. So depending on if your client is ready to spend, or if you are ready to spend, if you have multiple clients on that front, if you are into this business itself, then it's a good investment, I would say. It's not a expense, but it's an expensive platform that these guys operate. So Traction is one of them that I know.
Is it 1 lakh per annum, or am I getting it wrong?
I'm not sure. There is some timelines. You'll have to check their website. There are multiple this different.
Fine. Thanks.
Ways you can check.
Rahul, just one question. What's your take for, because from last 3 to 6 months, we have heard many of the large startups like unicorns also, BharatPay, Zilingo, as well as Go Mechanics also. Those startups are basically made into the news for all the wrong reason. Then basically, because those kind of the fraud, any kind of the irregularities, financial irregularities, because that financial due diligence also, because the companies which have invested into these startups are Sequoias, and those are the biggest, and they are also not found the irregularities in the due diligence. So what's your take on this?
So I'll tell you, due diligence are not done by the VCs. They appoint some or the other, mostly big four, if it's a large fundraise, and otherwise maybe a mid-sized firm as well, right? Mostly by chartered accountants only. So I think, again, when you talk about these frauds, right, I see that, intentional fraud is something very difficult to catch. Even audits cannot catch unless you do a thorough investigation with that mindset, right? That's what we all have been taught.
Yes.
So if there's an intention, I think it's very, very tough. It's very easy to say today, okay, what is Sequoia doing? So many companies, frauds are coming up. But I think that's all temporary phase. See, there are frauds, or I would say B-grade people in every industry, right? It happens at times. So we should not get so much bogged down with that. The purpose of DD is more towards analyzing data, analyzing numbers, analyzing the trend, analyzing. That is what DD does. The DD does not do vouching verification. Tomorrow, if suppose, for example, I'll give an example. I say that, okay, my turnover is 10 crores. Okay. What will our DD guy do? He will say, okay, 10 crores, fine. Can you give me a monthly breakup? I'll say yes. Then he will do what he will analyze from various different angles. He will see, okay, he will divide by number of products sold across 10 months. 10 crores, suppose 1 crore is my revenue per month. And then he will see what is my average selling price, right? That will if it's a fake number, that should trigger something. Okay, why the number is fluctuating so much? If you're saying X is the price, that could be one way of analyzing. Second, I try to map that 1 crore against my cash inflows with in the bank itself. So that cash inflow. Now tomorrow, if there's a founder who is hellbound that okay, I will do all level of frauds. These are, I'll say, okay, these are all B2C customers. I will put my from my pocket. I'm going to put 10 crores every time based on my. It's a I would say financial engineering. I'm ready to do. When every sale I book, I know I understand finance very well. I'm a professional finance professional, learned professional, and I create every dummy entry and put my own money just to showcase a fake number to someone. Then who is going to catch it? It's very tough. Then other way around, I could catch it that okay, actually you are saying B2C, then you must be having user database. Just show me your customer database. Then as a DD, I can check that. So customer database, I do some analysis on that. At some level, if someone is hellbound, okay, I'm going to do a fraud, then no DD can catch. But at a high level, if something is something that is a mistake or something that can easily be caught, or it's a small kind of thing some people do. But yeah, there are over smart financial engineers.
But Rahul, what I have heard from newspaper that in Bharat Pay, now the current existing investors are going to take some action which will nullify the shareholding which currently Ashneer is owning it. So what is that clause?
So that clause is in SHA. In SHA, what they say is that generally there's a standard clause of again same fraud, doing something illegal, etc. Right? In which because SHA is among the shareholders, right? If you do something, even your right on your ownership as well can go away. So exact term I don't remember what is that clause written, but it's part of the SHA itself, which can be triggered.
So basically, whatever their shares they are holding in their individual capacity would no longer be valid.
Yes, exactly.
Oh. Okay.
Is that happening with Mr. Ashneer now? Is the case on?
Yeah, case is going on. That will go for donkey years, I'm sure. It's not so easy to close.
Thanks, Mr. Sagar, for taking this up.
Yeah. Thank you, Rahul. That was really enriching session.
Thank you so much. Any other questions?
Now it is interactive. No, Mr. Rahul, initially you wanted it interactive, but then it unravels in the end.
Want another session immediately. Very nice one. 3 years, 2.5 hours has gone. We are not feeling it.
Rahul, because you've seen both sides, this fear of missing out or FOMO that is there among the PE investors, and also there's accusations of being, like a closed club, right? Okay, X is investing, so Y will also invest, so Z is also investing in something. To what extent is this really prevalent in the PE and VC funding industry? I mean, for us, it appears that it works. It works to a very large extent on that, right?
Absolutely, it does. I'll tell you. I'll give you an example. Hypothetical though. Say for example, the Taxi for Sure started in India, right? Yeah. So that's a Bangalore-based company, so I'm taking that example, but not. It's a hypothetical example. Taxi for Sure started. Sequoia invested in that company. Let's assume, right? Now and suddenly there's in the market. It's like wow, next big thing is these radio taxis, app-based taxis, etc. Right? Suddenly these Axel LPs will start beating their partners. Boss, what the hell you are doing? See, Sequoia, they have found such a good company. Why are you not able to? Now they are also trying, but they're not able to find a good company. Then they purposefully create one more company and start funding that because of that FOMO, fear of missing out. Tomorrow, I don't want my LPs to tell me in case that becomes successful. Though out of that 20 companies, I was okay to 18 to fail. They're okay to okay, let's take this as a risk because everyone thinks it's good. It may be good. Chalo dal do. That also happens at the back end. So on one side, for a founder, investors are seen as a god, but they are not. Even they are like ultimately like working for that particular fund for that company, earning salary and waiting to make a lot of money from it. Of course, since they are giving money, they are perceived as like they know everything. No, they don't. And raising money is not a validation of a good business model. I'm telling you very clearly.
So Sam Bankman-Fried's FTX is the new age fraud vehicle, right? In the old days, you had Bollywood movies, you had people clad in suits exchanging briefcases, and also there's a new age of frauds committing today, right?
I wouldn't say fraud. I would say it's a
no, but an insider, a smart insider who knows how this thing works can pull it off.
Yeah, easily. easily. And it happens all the time, always.
Yeah.
You won't even get a meeting with the right decision maker. I have seen a lot of, so I'll give you a bit structure of the VC, right? There's a partner, there's a principal, then there's an associate, and then there's a big team of analysts and backend accounting. So backend accounting is basically, again, just simple accounting, fund accounting, etc. These analysts are people who are expert in Excel, and they keep on analyzing models, market size, this, that, company's model, we'll ask questions, 200 questions. But the internal report that they give, partners and the principal don't even give a hit to, mostly. If they like it, I'm putting money. So that decision making and analysis are two different worlds inside the VC as well. But they need to do that analysis as well. Same thing with DD.
just to cover their tracks, right?
Exactly. Yes.
You've
That
taken
we
a
have done
decision,
enough.
how to justify that decision. There's all the backup for that decision making.
Exactly.
Yeah.
Just like we generally have seen that the companies, though they know all the answers, I have also done that. I know all the answers of times, but I need a before stamp in some document. So tomorrow I am not in a fix.
Yeah, correct. Right.
So that happens all the time. But decision is taken by the partner or principal level who understand. So they should know you, they should like you. If you go with the right reference, then there are high chances that you get funding easily. Reference is very, very important.
Yeah.
So Rahul, when the promoter sets up the company, the founders sets up the company first initially, so do they initially set up the company with the normal equity with one voting right only, or just to make sure that in future round of equity also their voting right also will be suitable to their shareholding? Will they issue the share initially at a like higher voting share? For example, what I have seen is that one startup initially only they have issued the share, one equity share with 100 voting right, so that in future whenever they are issuing the equity to some angels or VCs, they would have a normal voting right 1:1, but this guy as a founder is getting 1:100 voting right, so that at a dilution also he will have a suitable enough voting right in his favor.
Yeah, we call it DVRs. So DVRs are not very
DVRs.
common in India. It's not very common. Like for example, even listed company Tata Motors have a DVR listed. Right?
Yes.
Tata Motors DVR is listed. It's not very common in India, but nowadays new startups, new founders have found this very interesting. Right now, I am saying in your example, I am saying it does not matter when you're forming a company. It's all yours, right? Whether you put 100 or you put 1,000 votes does not matter. When you actually sit with the investor on a negotiation table, that time this has to be negotiated, irrespective. So whether you have put 100, then you'll have to issue them also 100 if they don't agree. Either they will say, okay, I'm not going to put money otherwise with this condition. But at times, in a larger companies, so for example, when you raise a good amount, right, that time what happens, this voting shares becomes important because founders, eventually what we have seen, right, when you raise up to Series C, D, E, F, your ownership comes to a very small one. Like for example, Flipkart, both the Bansal brothers had only 5% each. Now with that 10%, on a day-to-day business and all, you find it very challenging because every time you have to go to the board or to the shareholders and take, basically you are being controlled by someone else, right? So in that case, if you are a very strong founder and you can negotiate, that time these DVS come into play. And you can say, okay, ownership right is fine, but for the voting rights, I want this. So there will be additional. Now, on a structuring basis, as you are saying, initially, if I make 1:100, it does not matter because tomorrow, if you are a good negotiator, if the investor is ready to come, you can always say it can be a fractional voting right also. Say, for example, against every 3 shares, 1 vote will be counted. Even that can be done. I hope legally it's allowed. So that can also be done. So I don't see this to be a very innovative or very beneficial as such in the initial phase.
Okay.
Thanks, Mr. Rahul, for addressing all our queries. Yes, this is an end, but not the real end. We will connect to Mr. Rahul and have a follow-on session shortly. Mr. Ganesh Ramani, can you please come on video? I request Mr. Ganesh Ramani on behalf of Bangalore Valuers Association to extend a formal vote of thanks for today's speaker.
Thank you, Shilpa. Hey, hi, Rahul. It's I think more than 2.5 hours now. Yes. I think around 10. I think that explains. See, theoretically, there are 3 aspects actually which you try to cover, which is very interesting. One is the statutory part in terms of loss, what loss comes in, what goes out, how to take care of it. The second thing is about the commercial aspect, which is essentially how to understand the unit economics, the business aspect. And one good part, which you could see is start with a clean slate. most of the people try to think that they can get an existing standard document and try to fit in that. That never works. And that's an absolute valid point. And I think it's a takeaway. And the third aspect is jargons. I think this is a new age generation jargons of using the traditional English letters, abbreviate it and try to create confusion enough amongst people. But yes, that's a requirement if you are in the industry. Someone said TAM, SAM, Zoom. I was wondering what is it? Quickly, the moment you said it's adjustable market, I could easily relate to it. So I think what matters is how you brought all these things into a table, and you could bring in such a way that people can actually understand sequentially one after another. And that's a very important aspect. So if I were to bring in an analogy of a movie, the stories are the same. How well you do a screenplay and direction becomes the matters the most, and therefore the sequels come in. Similarly, in your case, the way you have narrated it, we require a sequel. You've been wonderful. Thank you, Rahul.
Thank you so much.
Vijaya, will you be able to share your screen now?
Yes, ma'am.
On behalf of Bangalore Valuers Association, a small token of gratitude. Mr. Rahul will be sending this on courier to you. Thanks a lot for a wonderful session. And I would like to thank all the participants for their, interactive and interaction and the questions. Yes, a very happy weekend for everyone. Thanks once again, Mr. Rahul. And this momentum will be forwarded to you on courier. Okay.
Sure.
Okay.
Thank
I
you.
will be in touch with you.
Thank you.
Thank you.
Thank you, everyone.
Thank you very much.
And I would like to put on record Mr. Nataraj efforts to, onboard this today's speaker. Thanks, Mr. Nataraj.
Hello. Can we have the PPT, Rahul, for this session?
Yeah, sure. I'll say that.
Okay. Thank you.
Thank you.
It was a nice session. A lot of insights, we could get out of this. Fantastic.
Thank you, sir. Thank you so much, sir.
Yeah, thank you.
Thank you very much. Very interesting session. Really liked it.
Thanks. Vijay, you can end the session.
Okay, ma'am.